Okay. Good evening to all present. I'm Mohit Vasan, Secretary, Ludhiana branch of ICI. Welcome you all in today's webinar on banking frauds and case studies. Today, we are going to discuss banking frauds and preventive measures to combat this type of threats to financial institutions, banks, and corporate. We will discuss the issues and practice to tackle them. We have our chief guest, our Central Council member, Charanjit Singh Nandaji with us. Sir, welcome, sir.
Thank you so much.
Our guest speaker, V. Somashekharji, is also with us. Now, I would like to hand over to Vasu Agarwal, our Vice Chairman of Ludhiana branch.
Hello all, a special welcome to you all from myself, CA Vasu Agarwal, on this very special occasion of Janmashtami. And it's my pleasure on behalf of the Ludhiana branch of NIRC of ICI to be able to host this seminar along with the Digital Accounting and Auditing Standards Board of ICI. The topic for today is the banking frauds and case studies, which we will discuss. And as you all know, that banking is one of the main core pillars of any economy. But as in the recent cases, we have seen that that many people are misusing this economy, a pillar of the economy. And so we have organized, IC has organized this seminar to be able to help people, the professionals to be able to update themselves regarding the latest scenarios that are happening in the economy. So now I would like to introduce our first speaker, Mr. Somashekharji.
Good evening.
First, I would like to invite Mr. Central Council member, Charanjit Singh Nandaji, to give a special remark, sir. Sir, please welcome.
Thank you, Mr. Vasu Agarwal. I can see CM Mohit Vasan, the Honorable Speaker of the session, Mr. Somashekar, who has been with the board since innumerable number of years. I would like to put across a very important and pertinent thing, that we have to all work towards a greater and a very efficient India. You are all aware that the Institute of Chartered Accounts of India was set up an Act of Parliament way back on 1st July 1949. When the most important document to the democracy, the Constitution, was not adopted. All of you are well aware that the Constitution to this country was adopted on 26 January 1950. The pertinent question that arises is, what prompted the Constituent Assembly to set up an Institute of Chartered Accountants of India, even before setting up their own democratic background? The answer is very simple, very forthcoming, very candid. They were looking for a disciplined band of soldiers to steer this country out of confusion. And I want to tell you that it is an onerous duty cast upon us as chartered accountants to ensure that things have to move in tandem with the best practices of the world. Financial frauds have been plundering the entire economy of the world over the years. And let me tell you, your board, the Accounting and Assurance Standard Board, is the first to come out with 23 forensic standards in the entire world. The entire world is looking towards us for guidance on forensic standards. And in this way, we are very keen to have more technical programs so as to hone the technical skills of our members. So that is why we thought it fit to have a very focused program on banking frauds, case studies, and ways to combat them. I become nostalgic when I speak of this because 20 years back, I was the chairman of Regional Council 2002-2003, and I did one program with the Central Bureau of Investigation, CBI. Mr. J.C. Rabas was the joint director at that time, and the name of the topic was similar: white-collar crimes and ways to combat them. Ladies and gentlemen, years may go, but fraudsters will always remain, and it becomes our imperative as chartered accountants that how we can change the entire perspective. We chartered accountants have the rare instinct of performance. I'm reminded of a couplet which says, "हम आज भी अपने हुनर से दम रखते हैं, हम आज भी अपने हुनर से दम रखते हैं, होश उड़ जाते हैं लोगों के जब हम कदम रखते हैं." You have to substitute logo with fraudster. You understand that wherever a chartered accountant gets involved, the entire fraud scheme starts getting unearthed. Ladies and gentlemen, we have specialized courses. We have financial FAMD course, which is totally with the forensics in technology. We do so many programs. So I'm very keen that we have to take a clue from this and change our practice to a newer area a greater encouraging and an area that imbibes in us the confidence to serve our motherland. So not taking much of your time, I would request Mr. Somashekar to come and guide the entire gathering with his words of wisdom. Mr. Somashekar, the dice is all yours now. Thank you.
Yeah. Good evening, sir. Good evening, participants. And thanks for the opportunity given to me by the institute to share some of my thoughts on a very important and sensitive subject, banking frauds. Let me first share the screen. I'll just. Can I just get a response? Is my screen visible to all?
Yes, sir, it's visible.
Okay.
Yes, sir, it's okay.
Okay. So this gives me an opportunity to share some of the important scenarios which we look into while handling foreign exchange transactions. So I'll start with the frauds in the international scenario, because my other colleague speaker, Ms. Gupta, will be talking about more on the domestic side. So whenever we talk about a particular deviation or a violation, or rather an aberration in operational issues, we need to look into whether it is a deviation from the internal control angle, or is it deviation from the internal guidelines, or is it deviation from the regulatory guidelines, or rather global guidelines. So here, whenever there is a deviation from the internal guidelines, that can be condoned by the internal management or by the top management of the organization. But whenever there is a deviation from the external guidelines, which we call regulatory guidelines, that cannot be condoned by the internal authorities or by the top management. It has to be condoned, or rather it has to be compounded by the regulator. So that is the sensitivity of a foreign exchange transaction in the international banking scenario. So whenever we talk about a domestic transaction, because there is only one currency involved, which is the home currency, it may not be implicating to the extent that implicates in case of a foreign exchange transaction. So when we talk about a foreign exchange transaction, it involves more than one currency, the home currency and the foreign currency. Because it involves more than one currency, it involves an international currency, it becomes regulated. So foreign exchange is a regulated product. Regulated in the sense, it's regulated by the Reserve Bank of India through the FEMA regulations, the Ministry of Finance, the Government of India, and even sometimes we even touch upon the FATF, Financial Action Task Force guidelines, the OFAC guidelines, so on and so forth. So with this background, I would like to start the session, starting with some of the context. So let us set the context. So this was one of the news items which came in July 2022. Banking frauds of over 100 crores see significant decline in financial year 22. So this might sound pleasing to some of the ears because the frauds have seen a decline. But in the right context, it should be taken in seriously, because even though it has declined, and here the banking frauds of over 100 crores see a significant decline. But that doesn't mean that frauds have declined. Frauds have been happening. So the context in which we look into in this particular news item is to be taken seriously. Now let us take the next. I have taken some data with regard to the banking frauds that happened between 2018-19 and 2020-21. And this has been extracted from the annual report of the Reserve Bank of India. So here, though we are more interested in all the figures displayed here, I will just highlight those which are in the red. So when we see the figures in the red, 2018-19, of the 71,534 crores involved in fraudulent transactions, 695 crores were from the area of international trade finance and foreign exchange. In the financial year 1920, of the total fraudulent amount, total frauds amounting to 1 crore 85 lakhs 468 crores. 54,000 crores were from international trade finance. Likewise, in 2021, of the total frauds covering over 1,38,422 crores, 129 crores were in the area of international trade finance and foreign exchange. So that gives us an eye opener as to we need to seriously look into, we need to seriously understand, and we need to be aware of the regulatory guidelines that are involved. Because any fraudster, for that matter, he takes advantage of the loopholes in the system. He takes advantage of the ignorance of the stakeholders in not knowing the latest developments in regulatory guidelines. And the fraudsters take advantage of the processes and the systems, which may not, or sometimes which will not be compatible to adhering to the regulatory guidelines. So this is one area where we need to look into seriously, especially in the area of international trade finance and foreign exchange. So before we go to the case studies, let me first analyze what are the areas of concern. So as a chartered accountant or as a concurrent auditor auditing the books of the bank, mainly the B category branches and the A category branches. So what are the areas of concern? What are the priorities for an auditor? What are the priorities for a concurrent auditor to look into when he's auditing branch transactions? So whenever we say branch transactions, I basically touch upon the B category branch transactions. Of course, I do make a reference towards the NRI, the FCRA transactions. But let us first see what are the areas. What are the areas of concern or areas which are prone to frauds? So before I go in detail about the areas of concern, I just wanted a small feedback from those on the platform. Am I audible? And can we go in the same speed which I am talking? Can you please give me a small feedback?
Yeah, sure. You can go ahead, sir.
Okay. So the first point which I thought I will share with you is the FCRA accounts. Accounts which are opened under the FCRA Act 1976, amended in 2010, and further amended in 2020. So whenever we talk about accounts under Foreign Contribution Regulation Act, any beneficiary in the nature of a trust or a society receiving foreign contributions from abroad require prior approval of the Ministry of Home Affairs. So that is known to all the participants in the webinar. So here, one of the major areas where frauds can happen is the inoperative FCRA accounts, the dormant FCRA accounts, and unclaimed deposits which are at the bank level. So here, as a concurrent auditor, whenever you are auditing, whenever you are looking into the books of accounts of the bank while doing concurrent audit, one of the basic concepts or one of the important points you need to look into is whether there are inoperative FCRA accounts at the branch level, dormant FCRA accounts at the branch level, which are being operated, especially during the course of your audit. Suppose if you are auditing for a period, say from 1st January to June 2022, just take out a list of those FCRA accounts where operations have been carried out. Those FCRA accounts which were inoperative, but operations were carried out. Because this is one area where even the insiders, even the people within the bank can take advantage of. Because these are accounts which have good funds, sizable balances in their savings bank accounts. FCRA accounts are nothing but either in the form of a savings bank account or in the form of a trust account where sizable balances are available. Maybe by virtue of certain administrative exigencies, or maybe because the trust is inactive, the balances or the accounts might not have been operated, as a result of which this would have become inoperative. So there are certain guidelines issued by the bank internally to the branches that wherever there are operations in the inoperative and dormant accounts of FCRA, a delegation is provided as per the delegation of powers booklet. That means the operations has to be approved either by the chief manager or by the regional manager or sometimes even by the circle manager. So as a concurrent auditor, when you are auditing the books of accounts, especially with regard to FCRA accounts, point number one, you have to see whether these FCRA accounts are supported with the approval from the Ministry of Home Affairs and whether the approval is in force, validity of the approval. And second, wherever there are operations in an inoperative FCRA account or a dormant account, please ensure that such operations were permitted as per the delegation of powers booklet of the bank. And this becomes very important considering the fact that this is one area of concern for the banks as well as for Reserve Bank of India. There are scenarios where many of the inoperative accounts were operated by the fraudsters and taken advantage of. So this is one area where concentration is required. Now, the second area of concern is the foreign money register. I will just explain to you what is this. Foreign money register is nothing but the replica of the physical currency notes held at the bank level. Physical foreign currency notes held at the bank level. So I'm sure many of you, when you're auditing B category branches, or rather even C category branches, you will be coming across branches handling encashment of currency notes. Okay, so here, wherever the branch is handling or branch is encashing currency notes, foreign currency notes for their customers, either NRIs or foreign travelers, it is very much important that the branch should be authorized by their head office or authorized by their regional office to handle foreign currency notes. So whenever a branch is intending or whenever the branch is handling foreign currency notes, they should have a prior approval from their head office or the central office or the circle office, giving them the powers to encash currency notes tendered by the customers. Not all branches are given this permission. So here, as a concurrent auditor, when you are looking into or when you are auditing the books of the B category branch, and if you come across that the branch is encashing currency notes for the foreign customers, foreign tourists, or for the NRIs, you have to ask the branch whether they have the necessary approvals from their head offices. And these approvals are given a one-time, it can be a one-time approval. It can be a year-wise renewal of the approval. Because this is one area where, again, the bank is exposed to risk, exposed to frauds. I'll just give you a small example. Say a customer, an NRI customer comes and tenders $10,000 foreign currency notes for FCRA account. So he wants to open a fixed deposit in foreign currency. He tenders $10,000 to the branch. Now the branch accepts $10,000 and opens an FCRA account for the customer. Now here, this has to be disposed of. This foreign currency notes has to be disposed of either on the same day to an authorized money changer, or it has to be disposed of the very next day. Because by holding foreign currency notes, the branch is exposed to exchange fluctuation risk. So here, sometimes it may happen that the person within the bank who has been entrusted with holding the currency notes in the double lock, he may dispose of to the authorized money changer at a higher rate without disclosing the rate at which he has been disposing of. And there are chances that this might be misused. So to ensure that the branch is acting as per the instructions given by the central office or the head office, central office or the head office generally provides authority only to select branches who are thereby authorized to handle currency notes, especially the foreign currency notes. And here the foreign money register plays a very important role. So all the currency notes accepted by the branch from their NRI customers and the foreign tourists should be routed through the foreign money register. There were certain scenarios earlier that the employees used to accept currency notes from the customers, call the authorized money changer, go for a bargaining of the exchange rate, and they used to convert into rupees and credit to the NRI account or the foreign nationals account without routing through the books of accounts, and thereby giving scope for encashing on the difference in margins. And this is one area where we need to be alert. And wherever the branch is authorized to handle foreign currency notes, they need to maintain a foreign money register as well as a cash vault, a cash register in foreign currency. And whatever notes are not disposed of at the end of the day has to be kept in double lock, and the physical notes should tally with the foreign money register. And this is one area where there might be a loophole where the fraudsters might take advantage of. The third area of concern is monitoring of office accounts. See, you are aware, as a chartered accountant, you will be knowing that there are lots of general ledger accounts which are in foreign currency, denominated in foreign currency. Say, for example, sundry liabilities, funds in transit, dollar account, sundry liabilities, funds in transit, euro account, FCNRB dollar account, FCNRB euro account, Likewise, sundry deposits, dollar account, sundry deposits, euro account. So there are lots of office accounts which are being created at the bank level. And here, each branch is having these accounts which can be operated upon wherever transactions exist. And this is one area. Office accounts is one area where a fraudster, in colliding with an external stakeholder, can create some entries, fictitious entries, and thereby taking advantage of these office accounts. So this again is one of the area where, as a concurrent auditor, you need to monitor. And whenever you are doing concurrent audit, see whether there are any office accounts in foreign currency where there are entries. Generally, office accounts in foreign currency do not have any entries, except if it is a category branch or if it's a trade finance center or a back office. Otherwise, any B category branch or a C category branch having an office account in foreign currency and which is being used for their transactions should be probed into. The next area of concern is the NRI accounts. Coming to the NRI segment, dormant NRI accounts, inoperative NRI accounts. This is again one more area where these accounts can be utilized. These accounts can be used to ensure that they can siphon off some funds. So here, NRI being abroad, he may be giving instructions to the branches, either over fax or over email, or sometimes online. So here, any NRI account which is not operated, say for example, for a period of more than 2 years, this becomes dormant or inoperative. So here, some of the insiders within the bank itself, they may take advantage of this. They may try using these accounts to transfer funds to accounts of their requirement. And this might not get noticed because the NRI being abroad, he may be traveling to India once in a year or once in 2 years, in which case he may come to know of these manipulations in the account. So before the bank locates this, so as a concurrent auditor, you are having certain systems in place. You have certain reports which you can take, wherein you can see whether there are any operations in the dormant NRI accounts, dormant inoperative NRI accounts, so that you can bring it to the notice of the branch and get suitable explanation as to what is this operation regarding. And again, wherever there are operations in dormant and inoperative NRI accounts, there are delegation of powers given by the head office of the bank or from the compliance department, which needs to be adhered to by the branches. And as a concurrent auditor, you need to ensure whether these powers has been used judiciously. Wherever you feel that there is something missing, or you feel you are not satisfied about this particular transaction, you can put this transaction in your inspection report so that the regional office, or even for that matter, the head office, can look into and speak to the branches, taking adequate clarifications on this. Now, the next area of concern is coming to exports, the pre-shipment finance and the post-shipment finance. There are scenarios where exporters, in collision with the bank employees, or sometimes exporters, even without the involvement of bank employees, they have been approaching the branches for frequent extension of pre-shipment and post-shipment credit. So whenever you look into the extension of a pre-shipment financing, the guidelines provide, the regulatory guidelines permit branches to extend the tenor of the pre-shipment credit, provided the reasons put forth by the exporter are beyond his control and acceptable to the bank. So here, what are the reasons beyond the control of the exporter? What are the reasons acceptable to the bank? These are the things which have to be probed into. So sometimes it may happen that the authorized person who is permitted to extend the pre-shipment finance, or the concerned authority who is permitted to extend post-shipment finance, he may not look into the regulatory guidelines, and the documents submitted by the exporter may not be satisfactory enough. And here, if there is frequent extension of pre-shipment finance and post-shipment finance by the banks based on the request given by the customer without looking into the veracity of the case, it might further lead into a fraudulent transaction. So again here, as a concurrent auditor, you have the wherewithal to speak to the branch manager. In case if you are not satisfied about the reasons provided by the branch for extending the PC or the post shipment, you may as well put your observations in the report. And this might attract the attention of the regional office or the head office, in which case they may ask for the detailed explanation from the branch. Frequent extension of export bills and write-off requests. Even here, write-off is one area where the exporter is unable to realize the bills from the overseas buyer despite his repeated follow-up. So there is a regulatory guideline. Reserve Bank of India permits an exporter to self-write-off or the bank to write-off, subject to 10% of the exports realized in the last calendar year, in case if the exporter is a status holder exporter, or 5% if the exporter is a general exporter. So that provision is available under FEMA regulations. But many of the exporters might take advantage of this. So here, what is it that is looked into? So whenever an exporter goes for a self-write-off, he needs to submit a chartered accountant certificate to the bank, wherein the CA certifies that his last year's export realizations were to the extent of so and so. So here, the exporter may be a status holder exporter or may not be a status holder exporter. But if he gives a wrong figure about his realizations in the last calendar year, he has taken advantage of the fabrication of this particular document. Likewise, some of the exporters, there are scenarios where they have exported the goods, but they have already, in collision with the overseas buyer, parked the amount in some other location. So the exporter has exported the goods, say for $1 lakh, and he has asked the overseas buyer to park the amount in some other account overseas, in some other bank. And in India, he approaches the authorized dealer for write-off. So this again is a fraud, because though the buyer has made the payment at some other location without the knowledge of the bank in India. So the exporter approaches the bank to write off, providing all the necessary documents, including the CA certificate, and the transaction is taken advantage of. So some of the fraudsters take advantage of the regulatory guidelines, regulatory provisions, which provide flexibility or option to the exporter to self-write off. So this is again one area. So where exactly the CA pitches in, the concurrent auditor. So whenever you are auditing a B category branch, wherever you are coming across write-off transactions, that is, you can take a report from the system. Wherever you have write-off transactions during your audit period, you need to go through deeper into the documents provided by the exporter. The powers, the delegation of powers booklet of the branch, who can permit write-off at the bank level, and whether the exporter has taken the necessary documentary evidences from the overseas buyer, or he has provided documentary evidences to the bank demonstrating that he has followed up with the overseas buyer. So these are the things which, as a concurrent auditor, you need to look into when you're auditing a B category branch. Now, next comes documentary credits. Again, when we talk about trade finance, international trade finance especially, LC transactions. So many of us have a feeling that if the transaction is coming under LC, the risks of both the bank, the exporter, and the overseas buyer is safeguarded, or rather the importer and the overseas supplier. But there are frauds happening under documentary credits also. So here, sometime when you look into the LC, I'll just give a small example. LC calls for documents prior to date of LC. LC calls for charter party bill of lading. LC calls for inspection certificate issued by the supplier. So these are some of the areas where there is a direct concern on the conditions. LC calls for documents dated prior to date of LC. LC calls for charter party bill of lading. And LC sometimes calls for the inspection certificate issued by the supplier himself. So whenever we come across conditions like this, there is something wrong in the structuring of the LC. So there may be a case where the exporter and the overseas buyer are hand in glove, or where the importer and the overseas supplier are hand in glove. So these are some of the terms and conditions which attracts the attention of a banker. Bankers should notice these conditions and see as to why these conditions are put in place. Merchanting trade transactions covering under LCs. So these are some of the documentary aspects which needs to be looked into when we talk about a LC transaction. Now, coming to advance remittances towards imports. This again is one of the areas. Advance remittance towards imports. An importer making advance remittance to the overseas supplier and getting the goods later, which is permissible under the FEMA provisions. But here, when the importer is making an advance remittance, he is getting funds from various sources within the country. RTGS from one bank, NEFT from another bank, check transfers, intra-bank transfers. So he is pooling the funds in the collection account, and from there, the remittance is being sent. So here, as a concurrent auditor, when you're looking into advance remittance transactions, when you're auditing a B category branch, where there are sizable advance remittances towards imports, you have to just go back into the account on a random basis, check whether prior to the date of advance remittance, prior to the date of outward remittance, whether the funds have been pooled from various sources, because this might be money from the money laundering angle. Again, this also might be from the fraudulent perspective. So here, advance remittance towards imports is one area where the concurrent auditor should not miss out, at least looking on to the big amounts, mainly on the documentary side. The next is delayed import payments. This again is an area of concern. Though FEMA provisions permit an importer to make delayed payment, that means any importer having imported the goods has to make payment within 180 days from the date of bill of lading. In case if the importer is unable to make the payment within the stipulated period for reasons beyond his control and acceptable to the banker, the delayed payment can go even up to 3 years period. FEMA provisions permit an importer to make payment for an import transaction even up to a 3-year period, subject to the interest not exceeding 350 basis points. ARR, alternate reference rate plus 350 basis points. So that is in the genuine interest of trade. In the interest of business, FEMA provisions permit flexibility. But here some of the fraudsters may take advantage. They have received the goods or they have received the commodity. They have not made the payment. Or sometimes the goods are lying in the port itself. It is getting delayed. So here this delayed payment may be in the interest of business improvement, but this might be taken advantage by the fraudsters. So wherever the branch has transactions where delayed import payment is executed by the importer, we need to look into as to what were the reasons which prompted the importer to make delay payment, and whether the reasons were beyond his control, and whether he had submitted the necessary documentary evidences demonstrating delayed import payment. Then transactions with wholly owned subsidiaries and joint ventures. So sometimes we come across trade transactions where your own overseas subsidiary is the counterpart. ABC in India having a subsidiary XYZ. So ABC is exporting to XYZ, or ABC is importing from XYZ. So this may be accommodative transactions. So any transaction with the sister concerns, any transaction with associate concerns, any transactions with wholly owned subsidiaries and joint ventures, if not looked into in full, that might lead sometimes to a fraudulent transaction. So as a banker, when a banker is getting a request from the customer to make payment to his own wholly owned subsidiary for an import payment, or getting receipts from the same wholly owned subsidiary towards an export payment, we need to dig deep into the transaction and see what is the basis, what is the underlying for this particular transaction, which necessitated the interrelated parties to handle trade transactions. Next comes to consultancy services and professional services. With the introduction of EDPMS, the export of goods, export of software is controlled. And with the introduction of IDPMS, the import of goods is controlled. But the gray area now is remittance towards consultancy services. An importer making payment to the service provider overseas, or an exporter rendering services to the overseas counterpart. These are not supported by the EDPMS or the IDPMS. So this is again one more area where it might relate to both frauds and money laundering. So here, as a concurrent auditor, as a chartered accountant, I have a small suggestion to be made. So wherever you are auditing a B category branch, you fix within yourself a threshold limit. So for example, you are auditing a big branch of a PSU bank. Say, for example, this branch has 20 transactions, remittances towards import of services. So just take out these 20 transactions based on the report you can generate. And in these 20 transactions, you can fix up a threshold limit. So let me check all the transactions which are more than $1 million. Or let me check all the transactions which are more than $5 lakh. So of the 20 transactions, if there are around 3 or 4 transactions which are more than $5 lakh, so you are in order in checking the documentary evidences. What is the underlying document the customer has given to the bank to make these remittances? Of course, you may be doing a post facto scrutiny, but nevertheless, it helps the bank in identifying whether there were any money laundering angle involved or whether there were any fraudulent transactions involved. Then merchanting trade transactions. This is again one of the most sensitive areas which are prone to frauds. Again, EDPMS or IDPMS does not support merchanting trade transactions. Merchanting trade transaction is one where the goods neither come into the country nor go out of the country. But the party, the merchanting trader, is in India. With the comfort he has with the overseas supplier and the overseas buyer, he handles this transaction. He facilitates the movement of goods from one location to another. So this is again one more area where this area is prone to frauds. So these are some of the transactions which are very sensitive in nature, at the same time, which might result in the bank facing the brunt from the investigating agencies. Now, let us go to the next point before we talk about the case studies. So, how to tackle this, or how to ensure that we are not falling prey, the bank is not falling prey to the frauds, or the bankers are not falling prey to the frauds. Understanding the customer becomes important. So, whenever we talk about a transaction, the customer's onboarding, understanding the importer, understanding the exporter becomes very important. So as a bank, I need to understand. So whenever the customer says, I want to make advance remittances towards imports or towards exports, he gets advance remittances. I need to understand. So as a bank, I should be aware of who is the overseas supplier in case of imports, who is the overseas buyer in case of exports, whether the overseas supplier is a sister concern or a JVWOS or a group company, whether the overseas buyer is a sister concern, a joint venture, wholly owned subsidiary, or a group company. And wherever there are advance remittances relating to imports, how many are backed by foreign bank guarantees? And wherever the advance remittances is being initiated by the customer, how many entries are pending for goods coming into the country or for goods shipped out of the country? Because under the EDPMS, I think many of you may be aware, under the EDPMS platform, or under the IDPMS platform, wherever the bank, an exporter receives advance remittance, wherever an exporter receives advance remittance, the bank creates a record called IRM, Inward Remittances Maintenance Record. And wherever the importer is making an advance remittance, the bank creates a record under IDPMS called ORM, Outward Remittances Maintenance Record. So these are the two records which are under control in the EDPMS and the IDPMS. So as a bank, they need to follow up with the exporter who has received advance remittance, whether he has exported the goods. At the same time, on the import side, under the ORM records, the bank needs to follow up with the importer for having made the outward remittance, whether he has got the goods into the country. So these are the two monitoring aspects that the bank is responsible for. And as a concurrent auditor, when you are auditing the books of a B category branch, you need to look into the fact whether the banks are following up with the customers. There should be a meticulous follow-up by the bank with the customers, with the importers and the exporters. And wherever as a concurrent auditor, you notice that there is not much follow-up done, or there is no seriousness in follow-up, you can put your observation in the report so that it reaches the head office or the central office, who can again drill on the bank. So this becomes very important. This is again a regulatory requirement. Reserve Bank of India today is very much concerned. There are lots of remittances where remittance has come into the country towards advance remittance for exports, but the exporter has not exported the goods. What happened to these rupees? On the other hand, there are lots of outward remittances towards imports, advance remittances towards imports, where the importer has made the remittance to the overseas supplier, but goods have not come into the country. So the country is concerned because foreign exchange has flown out of the country, but goods have not come into the country. So this is one area where as banks and as concurrent auditors, we can help the country in establishing and improving the forex reserves for the country. The second point is open account system. So understand the customer as to what is his model in either export or import. Whenever we talk about open account system, this is one area where the exporter exports the goods first. Open account is where the seller sells the goods first and he gets the payment later. That is, the exporter exports the goods first, basis which the buyer, after taking delivery of the goods, he makes the payment. Likewise, in case of imports, the importer receives the goods first and then he makes the payment. So here, this again is a concern. You need to understand the customer's model of business. As a banker, I need to understand what is the customer's model. If the customer says, I am exporting the goods first and then gets the payment, as a banker, I need to understand how many transactions are outstanding in EDPMS for which he has already exported the goods, payment is yet to come. On the other hand, as an importer, when I am getting goods first and then I have to make the payment, I need to understand as to when I am going to make the payment. So understanding the importer and the exporter becomes very important. And then we have merchanting trade transactions, where as a customer, I need to understand who is my counterpart. At the same time, I need to understand who is my counterpart on the export leg, counterpart on the import leg. So here, this is the basis for any transaction in foreign exchange, onboarding of the client by the bank. So when the bank is onboarding the client, the bank needs to understand what is the model of the business of the client, who are his counterparties overseas. So as an exporter, when he opens an account with the bank needs to understand whether the exporter is getting advance remittances towards exports, whether the exporter is handling exports under open account system, or whether he is handling merchanting trade transactions. Likewise, as a bank needs to understand under imports whether the importer wants to make advance remittances, whether the importer is handling under open account system, because understanding the client and onboarding the client becomes very important. And in today's context, it's not only KYC, it's not only know your customer, it's also know your customer's customer and know your customer's third party. Because in today's context, last year when FATF, Financial Action Task Force, had their deliberations, they were concerned about the third party involved in an international trade transaction. So who is the third party? Now, A is exporting to B. A is the exporter, B is the overseas buyer. Now, payment comes from a third party, C. So FATF is expressing concern across the globe that the third party might be involved in money laundering. A and B are known to each other. But when remittance is coming from the third party, FATF is concerned that the third party might be involved in money laundering while he is making the payment. So this again is concern. Know your customer, KYC. Know your customer's customer, KYCC. And very important, know your customer's third party, KYC, TP. So once the bank, when onboarding the trade customer, when they are aware of these three parameters in assessing the due diligence and the enhanced due diligence, frauds can be mitigated, frauds can be minimized. So at least there are some controls to be put in place while onboarding the client, because this is the first activity which, if not done properly, might lead to either a fraudulent transaction at a future date, or from the money laundering perspective, it may be becoming serious. So understanding the customer becomes important. That is the first step in ensuring that we are adhering to the guidelines and not ensuring and not going to the transaction, which at the end of the day results in a fraud or a money laundering transaction. Now we'll have a case study, a small case study, where I'll be explaining to you the intricacies of the transaction vis-a-vis the regulatory guidelines. Now, before this, I would like to just narrate the case. A is a private limited company, a non-borrower. They are into manufacturing of cotton garments in India. They are importing raw materials from their overseas wholly owned subsidiary from Taiwan. So A is a private limited company, a non-borrower. He is not a credit customer. He is a non-borrower, non-credit customer for the bank. They are into manufacturing of cotton garments in India. They import raw material from their wholly owned subsidiary in Taipei, Taiwan. Now, B, which is a wholly owned subsidiary, they have again one more subsidiary in Hong Kong. That means B has a subsidiary in Hong Kong, which is nothing but a step down subsidiary for A. So B in Taipei has a wholly owned subsidiary in Hong Kong who owns a cotton ginning unit, and they export cotton yarn to clients in India as well as to their parent in Taiwan. Now, A's imports. A is the importer in India, B is the wholly owned subsidiary in Taipei, and C is another subsidiary of Taipei. Now, A, who is the importer in India, they are importing under advance remittances, which constitutes 85% of the total imports, ranging from $50,000 to $60,000. And generally, the tenor of the transaction is in the range of 3 to 4 months. So A is importing under advance remittances. 85% of their imports are under advance remittances. Now, they have already made a remittance of $8.5 million since 8 months, and the current remittance is for $22,000. Now, the branch has put the transaction. The branch has processed this transaction, but the transaction is rejected by the nostro correspondent. That means the bank has already made an outward remittance to the overseas supplier, who is wholly owned subsidiary B. But the nostro correspondent in US, they have rejected the transaction with the reason wrong beneficiary details. Now here, what are the concerns here? So this case study brings out some of the concerns. There are certain red flags in this particular transaction. So here, A is the parent importing cotton from B, the wholly owned subsidiary. And B has again one more subsidiary called C in Hong Kong. And the parent in India is always making advance remittances for their import transactions, and they have already remitted $8.5 million. Now, this transaction is rejected by the nostro correspondent with the reason wrong beneficiary details. So what are the concerns here? So as a bank, when I am looking into this particular transaction, there are certain concerns, there are certain red flags in this transaction. If not noticed, this might lead to frauds. So what are the concerns here? See, the main concern is A is getting raw material from their own company overseas. So there are chances that there may not be any trade transaction involved. Point number one, A importing from their own wholly owned subsidiary. There may be a case where A is not at all importing. Just to accommodate B in the overseas location, they're making outward remittances in the guise of advance remittances. That may be one concern. Now, second concern, they have already made $8.5 million in the last 8 months. So as a bank, I need to understand, or I need to find out whether they have already got goods into the country, at least for 90% of this $8.5 million. I repeat, since A has already made a remittance of $8.5 million to the overseas subsidiary in the last 8 months, as a banker, I need to check with A to the extent of $8.5 million, how much goods have come into the country. Because as per regulatory guidelines, any importer who makes an advance remittance should get goods into the country within a maximum of 6 months from the date of making the remittance. So this again is a concern. So as a bank, I should have questioned this. Point number 3, when all the transactions in the past 8 months have not been rejected, why suddenly this transaction is rejected by the nostro correspondent? So these are the red flags in this transaction. So keep in mind, as a concurrent auditor, whenever you are auditing a B category branch with regard to import transactions, you can take a list of advance remittances during the audit period. Suppose you are auditing for a period 2021-22. Say you are auditing for the period 1st April 2021 to 31st March 2022. So today you are auditing. So when you are auditing today for the last 1 year period, take out a report from the bank systems as to how many transactions pertaining to this branch, how many customers in this branch have effected advance remittances towards imports in the last 1 year. And of the total remittances, how many are outstanding more than 6 months? Because any transaction which is outstanding for more than 6 months in the system, that means the goods have not come into the country. Because once the goods come into the country and the importer submits the bill of entry, the entry gets knocked off in the IDPMS. So that as a concurrent auditor, you can look into and see whether there are any concerns on this particular transaction, which has already happened. So this is one area where customers take advantage of. A parent in India remitting to the subsidiary abroad in the guise of advance remittance. A company in India remitting to the sister concern overseas, to the wholly owned subsidiary overseas, to the associate firms overseas. This may be to accommodate them to tide over their temporary working capital requirements. So this is one area where frauds can happen. So what are the concerns? These are the concerns. Now, what is the learning? So whenever we are looking into an import transaction where advance remittances have been made, source of funds is very important. Whether the source of funds for this outward remittance came through cash generation or cash flows from the company, or whether it was from pooling of funds. So I will just give you a small reference to the Bank of Baroda scam, which happened in 2013-14. So in 2013-14, 48 Benami accounts were opened at the Ashok Vihar branch of New Delhi, Bank of Baroda, where the fraudsters siphoned off around 6,500 crores in the guise of advance remittances. So they pulled in money from various accounts within the bank and through various banks. They collected funds from various sources, and all the amounts were pulled in a single collection account. And from this collection account, they remitted to the extent of 6,500 crores in the guise of advance remittances towards imports in a span of around 14 months. And the total number of transactions were around 8,500. And this didn't came to light. This came to light only when the bank followed up with the importers for bill of entries. So only when the bank followed up with the importers for the bill of entries, and when the follow-up resulted in no response from the importers, then investigation was carried out. And during the course of investigation, it was found out that the onboarding of these customers were faulty. These customers were not existing. They didn't have a place of business. They didn't have a line of business. They didn't have a track record. Basis which the bank was penalized for not adhering to the regulatory guidelines. So pooling of funds, the modus operandi used by the fraudsters where they pooled funds in one collection account at Bank of Baroda from various other sources. And this was siphoned off overseas. And added to that, in today's context, you have what is called as the IDPMS. So wherever the importer is making an outward remittance towards advance, the entry gets recorded in the ORM, Outward Remittances Maintenance Record. And as long as he is not submitting the bill of entry to the bank for having imported the goods, the entries in ORM remain outstanding. And this is again one more area where, as a concurrent auditor, you can look into by doing concurrent audit. Just take out the list of ORM entries pending at the branch level. And of the total number of entries pending at the branch level, see whether there is concentration of a single importer or two importers. Because sometimes a single individual, a single importer may be having more number of entries pending. And there you need to put up in your report as to what is the follow-up that the branch is doing. Whether the branch is meticulously following up, or what are the lapses at the branch level in not following up of the transaction. And very important in today's context, building threshold limits. So here under the digital platform. So today, many of the private sector banks and many of the big banks, they have put in place a digital system where they fix up a threshold limit to control the transactions not going beyond the threshold limit. Alerts are generated. So I'll just give a small example in this case. Now, in the case study we looked into previously, 85% of the total transactions of this particular customer was under advance remittances. That means in a year, when he is remitting 100 transactions, of the 100 transactions, 85 transactions are towards advance remittance. That means build up an alert in the system that within 6 months, if the goods are not going to come into the country, and if the number of entries where goods have not come into the country are reaching this threshold limit, stop doing further transactions for this customer. So the system will look into the scenario. System will look into the scenario built up in the system, and they will refuse to handle further transactions. So suppose in this particular case, if the branch decides, if the branch creates a scenario that if the total entries pending are more than 10%, I will stop doing further transactions. That means if this is defined in the system will not allow further transactions to happen. So taking back again the example of Bank of Baroda, in the Bank of Baroda Ashok Vihar branch, around 8,800 transactions were processed at the bank level, at the branch level. So had this alert been put in place at that time, that is of the total transactions, if 10% of the transactions are outstanding beyond 6 months, I will stop doing further transactions. If that alert was built, then this fraud would not have happened to that extent. So in today's context, digital banking has played a very vital role. Many of the private sector banks, they have put in place systems to ensure the system brings out an alert based on the threshold limit. So if this is put in place, if these controls are put in place, frauds can be avoided to a large extent. In other words, digitization is one solution which can help in minimizing these frauds. Now we'll come to the next case study. So before we go to the case study, I just want a small feedback from the coordinators. Am I going in the pace in which the participants are able to hear? Whether there are any questions from the participants?
So basically, I'm getting one question from Sharad Agarwalji from Gwalior. It's not a question, but basically more of a suggestion. What he feels is that there should be an annual exclusive FCRA or FAMA audit of banks.
They should be exclusive?
No, not exclusive. Annual FAMA and FCRA audits of banks.
Actually, it was there. Just to clarify the point raised by the participant, there was an audit under Section 35 of the Banking Regulation Act, where all the B category branches had a specific FEMA audit. But in the current context, slowly, gradually, this was dispensed with, because in the current context, when you see the foreign exchange transactions being processed in the last 4 to 5 years, almost all the banks have centralized their processing of foreign exchange transactions. As a result of which, the FEMA audit of B category branches, the FERA audit of the B category branches was dispensed with. Because now all the transactions happen at a centralized level. Most of the banks have centralized their trade finance transactions, including banks like State Bank of India. So as a result of which, all the documents which are received by the branches, they are scanning it to their centralized unit and they handle the compliances and the transactions. Maybe with that in mind, the FEMA audit was dispensed with. But I agree, I appreciate the participants' view. It is required. It is very much essential that at least on a half-yearly basis, the branches are audited from the point of view of FEMA. Thank you for your question. Yeah.
There's just one more, I think, more of a clarification from Chavala Ananda Kumarji from Chennai. He was, I think, he was referring to the first slide where you were telling about the FCRA accounts. He's just clarifying it that it's not called FCRA accounts. It's now called FCNR accounts. So
no, it is wrong. It is not FCNR because FCNRB accounts are for NRIs. Any non-resident Indian opening a foreign currency account in fixed deposits. FCNRB is foreign currency non-resident bank accounts. FCRA account is accounts under Foreign Contribution Regulation Act. So here, all the banks, what they do is, whenever a society or a trust or a charitable association, they open a trust account and they are receiving inward remittances from abroad in the form of foreign contributions and donations. The scheme code they use is Savings Bank FCRA, current account FCRA. That is the scheme code they use. SB FCRA means SB account opened under the provisions of Foreign Contribution Regulation Act. Current account FCRA means current account opened under the provisions of Foreign Current Contribution Regulation Act. FCNR is foreign currency non-resident bank account. That is for NRIs.
Okay, sir. I think you can go ahead. There are no more queries with me.
Okay. So I can go in the same pace. No? I think I have some more time to handle.
Yes, sir, you still have for half an hour. You can keep going.
Okay. So now I will, thanks to the participants for raising these two questions. Now I come to the second case study. This is one of the important case studies. Of course, these are live case studies which has happened in the Indian international trade finance area. So here, this case is slightly elaborative, but very important to understand the concepts in this particular case study. So here, I would request the participants to concentrate on whatever I'm reading out, so that at the end of the case, you will understand the sanctity of adhering to the regulatory guidelines, the PMLA guidelines, the FATF guidelines, and also the customs guidelines. Now, parties to the case. Party A is in gold business and dealing since 2010 with 8 banks in the consortium. So A is the party who is into gold business and dealing since 2010 with 8 banks and in the consortium. Now B is a SEZ unit. So SEZ is Special Economic Zone, unit in the Special Economic Zone. So B is a company which is owned by A and they are a Special Economic Zone. They are a unit in the SEZ. Now X again is a party in Hong Kong. X is a company which is a joint venture between B and X. B is the Indian company, X is the overseas company. So X is a joint venture between B and X in Hong Kong. Now Y again. Y is again a Hong Kong based company. It's a joint venture between B in India, X in Hong Kong, and Y. So these are the 4 parties to the case. A is the parent dealing in gold business since 2010 and dealing with 8 banks, consortium of banks. B is a subsidiary of A in India, which is a SEZ unit. X is a joint venture between B and X. Y is again a joint venture in Hong Kong between B, X, and Y. These are the 4 parties to the case. Now, what is the gist of the case? Point number 1, B was formed in 2015. B, which is a subsidiary of A, was formed in 2015, and they are into both imports and exports. But as per ROC, as per the Registrar of Companies, the activities of B are supporting ancillary transport activities, travel agency services. So B was formed in 2015, and they are both into exports and imports. And as per the ROC, they are into supporting ancillary transport activities, travel agency services. Now, X, which is a joint venture in Hong Kong, X holds 99% of the equity in both the companies of X and Y. That means X in Hong Kong is a joint venture between B and X. So X holds 99%, B holds 1%. Likewise, X also holds 99% in Y. That means Y again is a joint venture between B, X, and Y, where X holds 99%, Y holds 0.5%, and B holds 0.5%. Now B, the Indian company, they are into export of diamonds to X and Y, where 80% of the exports in India are handled through a state-owned bank. And the total turnover and their exports is $220 million. What is it that they are exporting? They are exporting 925 silver-studded jewelry and 9-carat gold diamond stone-studded jewelry. And for the export that B is making, they are importing rough and cut diamonds from both X and Y in Hong Kong. And the total import turnover last year is $212 million. So what does this give? B is a subsidiary of A. B is dealing in export and imports. For all the export of diamonds they are doing only to X and Y, which are their joint venture companies. And for whatever exports they are doing, they're again importing the raw material, rough and cut diamonds from X and Y. And the total export turnover was $220 million. The total import turnover is $212 million. Now, B's import payments. B is importing the goods, importing rough and cut diamonds through advance remittances. B is importing. That is, the payment they are making to X and Y is in advance, and then they'll get the raw material into the country. And this import payment is done through pooling of funds from over 500 accounts through RTGS, NEF, from various firms and companies involved in this particular business. So B is collecting the funds from various accounts, around 500 accounts, who are also involved into these particular businesses, and they are pooling the funds and they are making remittances to the overseas supplier, who is their own joint venture. Now, all export documents, imports are under advance remittances, whereas all export documents, they are through open account system. So what is open account system? Sometime back I told, where the exporter exports the goods and dispatches the documents directly to the overseas buyer. The buyer takes delivery of the goods and then he makes the payment. So that is open account system. So all the export transactions of B, whatever diamonds they are exporting, they are directly exporting to the overseas buyer. They are dispatching the documents directly to the overseas buyer, who is their own joint venture, X and Y, and they are releasing the payment after taking delivery of the diamonds. And all realizations are handled through the same state-owned bank. So this is the gist of the case. So here, what are the concerns? What are the red flags? So here, many of the participants would have noticed that there are lots of deficiencies in the model. The model adopted by the exporter, there are lots of deficiencies. There are lots of, what I should say, aberrations in the model he is following. Point number one, A is in gold business since 2010, dealing with 8 banks. So A is not exporting and importing, but he has formed a company called B, who is doing exports and imports. Again, one more deficiency is the overseas joint venture, X, is nothing but B and X, where X holds 99% of the stake and B holds 1% of the stake. And Y again is a joint venture, which is a joint venture between B, X and Y, where again X holds 99%, B and Y hold 0.5% each. So what does this mean? This is a closely knit business conglomerate, A, B, X and Y. So that itself gives certain doubts for the model of this transaction. Now the second red flag, second concern, as per the ROC, B is into ancillary transport activities, travel agency services. But the transactions he is doing with the bank is export of diamonds and import of rough and cut diamonds. So that again is a red flag. Now point number 3, again, one more red flag. B is exporting diamonds to X and Y, getting raw material from X and Y only. Maybe there may be a genuine requirement of raw material from X and Y, but again, exporting to X and Y. That again is a concern. Another concern, B is making remittance in advance. B is making remittance in advance to the joint ventures, but at the same time, they're getting remittance only later after exporting the goods from the joint ventures. So that again is a concern. When B is making an advance remittance to X and Y, it's quite natural that X and Y should make the payment immediately on receiving the goods, but they're not doing that. It's on an open account system. B is sending the goods first, and then he is getting the payment. This again is an aberration. And the very important red flag here is they are pooling the funds from over 500 accounts through RTGS, NEF. And every transaction, all the entire transactions are handled through one state-owned bank. So this again gives suspicion as to why they are linked only to a particular bank. Though there are 8 banks in the consortium, why they are adopting their exports and imports only through a single bank. So this is a case study where you get all the parameters relating to both money laundering and fraudulent dealings. So the concerns are this. So here I have given some of the points in red, which are nothing but red flags. X is a joint venture in Hong Kong, who is nothing but promoted by B and X. Y again is a joint venture in Hong Kong, promoted by B, X and Y. So these are the red flags. The other red flag, as I told, supporting ancillary transport activities, travel agency, as per ROC. But as per the real scenario, they are into export of diamonds and import of rough and cut diamonds. Pooling of funds from over 500 accounts, that again is a red flag. Documents on open account system. So all the exports which B is doing is under open account system. So these are the concerns in this particular case. And the result is, what is the learnings from this business, from this case study? We need to look into the line of business. The line of business should be in consonance with the main line of business. That means As per ROC, the line of business is transporting and travel activities, whereas the actual activity is export and import of diamonds. The track record needs to be looked into. Creditworthiness, compliances relating to exports under open account system. So whenever a party is doing exports under open account system, as per regulatory guidelines, he should be a status holder exporter. Status holder exporters are permitted to handle exports under open account system. All exporters other than open status holder exporters, they need to route the documents only through the banks. And again, here compliances relating to JVWOS. So here, in the previous case study we looked into, here actually the customer has subsidiaries. B being a company in India, they have a subsidiary in Hong Kong, a joint venture in Hong Kong called X. They again have one more joint venture in Hong Kong called Y. So what are the compliances that have completed? That also needs to be looked into. So whether they have complied with the regulatory guidelines of RBI in establishing a joint venture or a wholly owned subsidiary abroad. And very important, alerts. So here, as I told you in the earlier case, the digital platform of the bank can support minimizing aberrations like this. Threshold limits can be fixed. Alerts can be generated wherever there are transactions which might result in under invoicing or over invoicing. The system can generate alerts. So the bank, the operations team should sit with the IT team. They have to explain the various scenarios under which regulatory guidelines are put in place. And the system can understand the regulatory guidelines, and they can generate alerts. So many of the private sector banks and a few big public sector banks, they have put in place the alerts based on the threshold limits defined in the system. And interestingly, in this case, the main account of A Private Limited at the state-owned bank was a non-performing asset in 2014. The main account, the parent, A Private Limited, was a NPA in 2014. CBI had investigations into the affairs of the company in 2014, consequent to which the MD of the state-owned bank was arrested because he was possessing 4 kgs of gold at home and 6 kgs at office. So interestingly, this was the point which was, this was one of the important points which emanated in the investigations. It was a NPA in 2014, but B, because the parent became NPA, another company was formed called B, and B was asked to do export and import business, thereby resulting in both money laundering and frauds. And because the MD of the state-owned bank collided with this particular company in ensuring that all the transactions are routed through one single bank, the MD also was arrested. The MD was possessing 4 kgs of gold at home and 6 kgs at office. So this is one of the cases which resulted both in frauds as well as in money laundering. So party also contravened the provisions of PMLA. Party also contravened the provisions of Income Tax Act. Party also contravened the provisions of FEMA regulations and customs regulations. So all clubbed together was found in this particular case study. So what is the learning we look into now? Onboarding the client becomes very important. So any foreign exchange transaction, any international trade transaction, the first point that the bank needs to look into is the onboarding template. What is the controls put in place while onboarding the customer? So when we say onboarding the customer, whenever you are onboarding a customer who are into domestic transactions, KYC refers to the address proof, ID proof, address proof and ID proof. But when you talk about a foreign exchange transaction, when you talk about a trade transaction, international trade transaction, KYC does not only mean ID proof and address proof. KYC also needs to be looked into from the point of view of line of business. What is the line of business of my client? What is the track record? Is the track record and line of business in consonance with the activity he is dealing with? And very important, know your customer's customer. Who is my customer's counterparty? Who is my customer's third party? With which country my customer is dealing with? Who are the various suppliers overseas who are dealing with my customer? Who are the various buyers overseas who are dealing with my customer? So this is an elaborative area of conducting a due diligence and an enhanced due diligence. Basis which thresholds can be put in place, alerts can be put in place. So today there's a system. Some of the banks have a system in place through their digitized platforms that for the first 6 months, any trade customer, any customer who is dealing in exports and imports, for the first 6 months, the system generates alerts on the activities in the account of the transaction based on the threshold limits put in place. So in this case, suppose, for example, the importer, for the first 6 months, the importer's transactions are monitored through the system. A scenario is created in the system that if the transaction amount exceeds this much, generate an alert. If the number of transactions cross this particular number, generate an alert. Or if the amount is going to other than the suppliers who are already created in the system, create an alert. So there are lots of threshold limits based on the recommendations of IBA. Many of the private sector banks have put in place certain threshold limits and also alerts, which give an indication to the branch staff that there is something which needs to be now looked into, basis which an enhanced due diligence can be looked into. Now, we'll go to the next case. Of course, here we have another 14 minutes time left. So this again is one of the interesting cases which resulted in frauds, both from the point of view of domestic transactions as well as international transactions. But I am afraid whether I'll be able to complete on time. We have another 14 minutes time left.
Sir,
Yeah.
sorry to interrupt. Someone
Yeah.
had a question regarding
Yeah.
first case study.
Yeah.
It's Mr. Ramesh from Hyderabad.
Yeah.
In case his query was in case one which you just discussed, because there is no finance from that branch, that bank will be complacent despite the fact that there is a remittance out of the country by way of advance. So
Can you please come again? Can you please come again?
He's
Case
basically-
one, case study
Yeah,
one, or case
I
study
think
two?
case study one.
Okay. Tell me, because
Because he's saying the bank, since there is no finance from that branch, the bank may be complacent despite there is a remittance out of the country by way of advance.
yes, that is a valid point, because many times as a branch, they will be complacent when the customer is not a credit client. Because when a credit client is dealing with the bank, they know that the credit department has done the necessary due diligence, assessment of their financials. They have sanctioned the credit facilities. So there is some control. Because the customer is a non-credit customer, sometimes branches may be complacent. Or there's one more advantage of a non-credit customer. He may be bringing in good amount of balances in the current accounts, the CDAB. Cumulative daily average balances will be good in case of non-credit customers. The point of the participant is very valid. Because he was a non-credit client, branches might have been slightly complacent towards these particular transactions. That's right.
Okay. Sir, just one more thing. Chawalaji from Chennai is again asking, what is an open account?
Open account is, I had given a small concept on this. Open account, see, whenever exporter is exporting the goods, either he can export the goods and send the documents through the bank, or he can export the goods and send the documents directly to the overseas buyer. So wherever an exporter is exporting the goods and sending the documents directly to the overseas buyer, the buyer takes delivery of the goods after submitting the documents to the customs, and then he makes the payment. That is open account system. So in international trade, 80% of the transactions, 80% of the trade transactions globally happens through open account system. That means documents do not pass through the bank. Documents are directly exchanged between the exporter and the overseas buyer in case of exports, importer and the overseas supplier in case of imports. That is open account system.
I think so. You can continue now.
Okay. So here, this is a case which is again very interesting. X in India, he is a credit client of your bank. Of course, your bank means the bank where you are doing concurrent audit. X in India is a credit client of your bank, dealing in pulses. He enters into an agreement with overseas counterparts for supply of earth-moving equipment from Y in Indonesia to Z in Cyprus. So what does that mean? X is a credit client of your bank where you are doing concurrent audit, and X is dealing in pulses. X enters into an agreement with the overseas counterparts. So X is entering into an agreement with Y in Indonesia and Z in Cyprus for supply of earth-moving equipments. Now, how Y and Z came into contact with X? Y and Z were introduced to X through a third party A in Manila during an international event a year back. So this is the first paragraph of the case. Now, Y from Indonesia. That means if you look into the first paragraph, Y is the supplier of earth-moving equipments. Z is the buyer. Y in Indonesia is the supplier. Z in Cyprus is the buyer. Because Y and Z are not known to each other, X is acting as a merchanting trade trader. This is a merchanting trade transaction where X sitting in India is facilitating supply of earth-moving equipment from Y in Indonesia to Z in Cyprus. Now, how Y and Z came to know about X? They were introduced by a party called A during one of the international seminars. Now, Y in Indonesia, who is a supplier, he has a branch in Singapore. Z in Cyprus, who is the buyer, he has a branch in Singapore. Okay, so Y in Indonesia has a branch in Singapore. X, Z in Cyprus has a branch in Singapore. Now, the import leg, that is the Indonesian supplier, is supplying the goods at 180 days credit period. That is the supply from Indonesia. Y in Indonesia is giving a 180-day credit period to X. At the same time, X is getting advance remittance from Z. That means when Y and Z, Y is supplying goods to Z, Y has told X, you pay me after 180 days. But at the same time, X is getting advance remittance from Z. And branch today has received an advance remittance. Now you are doing the concurrent audit of this particular branch. Today, there is a news in the branch that they have received 5.3 million advance remittance from A2 in Mexico on behalf of A in Manila. And this amount has to be utilized for regularizing the irregularities in the CC account of X2, which is subsidiary of X in India. So here, maybe participants may not immediately get a glimpse of this case. I'll just give you the snapshot of this. X is Indian. X is a trade customer in India. Y is a supplier in Indonesia, supplying earth-moving equipments to Z in Cyprus through X. X is the mediator. X is the merchanting trader who has told Y in Indonesia to supply earth-moving equipments to Z in Cyprus. Now, the import leg, that is X is telling Y, I will pay you at the 180th day, you supply the earth-moving equipment. At the same time, X is telling Z, you pay me advance remittance, I will supply you the earth-moving equipment. Now, today, branch has received an advance remittance of 5.3 million for this transaction. And that has come not from Z. It has come from A2. A2 is a subsidiary of A. And A2 is in Mexico. And this amount, which has come as advance remittance for the merchanting trade transaction, the customer is telling, use this for regularizing my CC account, my subsidiary CC account. So what are the concerns here? What are the red flags here? So this again is one of the cases. Again, this is a case which has happened. This is one of the cases where there is direct reference to money laundering or fraudulent motives. So X in India, he is having a contract with Y for supplying earth-moving equipments to Z. So Y and Z, they both have branch offices in Singapore. So when Y and Z have branch offices in Singapore, where they are in the same location, how they are not aware of each other? That is the point which comes to light. That is one point. Now, point number 2. Import leg is 180 days. X is telling Y, I will pay you on the 180th day. But on the other hand, he is demanding advance remittance from Z immediately. And Z, instead of Z making the advance remittance is coming from Mexico. Mexico is a drug trafficking country. Advance remittance is coming from Mexico. And that too is coming from A2, which is a subsidiary of A. And A is nowhere involved in this transaction. And this remittance is not utilized for the merchanting trade transaction, but this is utilized for clearing the irregularities in the cash credit account of X2, which is the subsidiary of X in India. So this gives some immediate reflection on there is something amiss in this transaction. Of course, this transaction happened, and later when the investigating authorities pointed out, the eyes of the concerned stakeholders came into picture. So these are the concerns. So what are the concerns here? Dealing in pulses. X is dealing in pulses, but he is agreeing to supply earth-moving equipment. So the line of business is not in consonance with the line of business of the original company. X is dealing in pulses. At the same time, when they say I'm supplying earth-moving equipments through Y, it is not linking to each other. So as per the regulatory guidelines, any merchanting trade transaction, the merchanting trader, the business in which he is dealing, and the transaction in which he is involved should be in consonance with each other. So it's a red flag. The second red flag is Y has a branch in Singapore, Z has a branch in Singapore. How is it that they are not aware of each other? For a very big deals like this, they should be knowing each other because both are having their branches in Singapore. Point number 3, the import leg is 180 days from bill of lading, whereas the export leg, X is getting the amount immediate. So what he is doing with this amount? He is regularizing the irregularities in the CC account. So any foreign exchange remittance coming into the country for a purpose and not utilized for the same purpose is a violation. So this again is a concern in this particular case study. So if not noticed, if these concerns are not brought to light, if these concerns are not escalated to the senior authorities, this results in frauds. So I think I will come to the, I will skip case study 4 because of the time constraint. If time is available, I can come back. So some of the early warning signals relating to international trade transactions, foreign bills outstanding for longer period is an early warning signal. So as a bank, I need to be alerted. And as a concurrent auditor, you need to look into how many bills are outstanding, basis which you can put your observations. Overdue entries in IDPMS, EDPMS. This again is an early warning signal. A customer having number of entries in the EDPMS, number of entries in the IDPMS means he has not regularized either his export transaction or his import transaction. Import leg not revealed in respect of merchanting trade. These are some of the early warning signals which as a bank I need to be alert of, and at the same time as a concurrent auditor I need to look into and put my observations in the report. Now the last slide for today, some of the key concerns of FATF, Financial Action Task Force. During the plenary meeting in September 2021 last year, FATF has expressed concerns, and some of the concerns relevant to banks are implementing customer due diligence, identity verification, record keeping, customer information has to be done seriously. Regulated entities, that is banks and financial institutions, if they are relying on third party to conduct the customer due diligence, they are responsible. That is again one more concern of FATF. Now there are certain category of professions called designated niche non-financial business professions. So some of the professions like casinos, real estate agents, dealers in precious metals and precious stones, lawyers, notaries, and legal practitioners, accountants, they are coming under the category designated non-financial business professions. So here FATF is asking all the countries across the globe to do additional due diligence whenever they are dealing with such professions. NPOs, NGOs, non-governmental organizations, non-profitable organizations. FATF is concerned that many of the countries do not have laws in place because these are used as conduit pipes in money laundering. Of course, in India, we have the Foreign Contribution Regulation Act, which caters to ensuring that the funds received are not used as conduit pipes for money laundering. Wire transfers. Again, FATF is concerned. Whenever there are wire transfers emanated between the banks, unless the wire transfer contains full originator details, banks should not process the remittances. And very important, the alternative remittances channel, the AD2 category, the PayPals, the Razorpays, the Flipkarts, the Amazons, So FATF is concerned that any person who is acting as a franchisee, any person who is acting as an alternative remittance channel, they should be registered with the local regulatory authorities. So these are the key points which are relevant to banks where FATF has expressed concerns in their last meeting in September 2021. Now, what is the way forward? I will just finish off with the points highlighted in red. Generating alerts and monitoring. So today, digitization plays a very vital role in minimizing or mitigating or stopping the frauds happening. Generating alerts through the system, monitoring such alerts through the system. Internal audit again becomes very important. Use of technology. So today, many of the banks have put in place screening of transactions with reference to pricing of the commodities. This becomes very important to arrest undervaluation or overvaluation, under invoicing or over invoicing. And finally, training of the audit staff, training of the inspection staff, and also a step ahead, training the concurrent auditors who are auditing the bank's transactions. So this is overall my thoughts on frauds, banking frauds, how it can be stopped or how it can be controlled. So now I leave the platform open to the moderator, because with the limited time available, I was able to bring in some points which may be of interest to the participants. Thank you very much.
Thank you, sir, for the wonderful session. It was a very great deliberation on the topic of banking frauds. There are some queries which I think we will take up at the end now. Okay. We have a second chief guest of the day, CA Dayanivas Sharma ji with us. He is the vice chairman of the Digital Accounting and Assurance Board of ICAI. He is also PwC alumni, where he did his articleship in Hyderabad. Thereafter, he joined Sri Lakshmi Nivasan Company and is currently the managing partner of the firm. He has over 20 years of experience in the field of auditing, accounting, corporate restructuring valuations, and due diligence and transaction advisory services. He has been elected to the Central Council for the last 2 terms from 2019 to 2022, and in the current term also from 2022 to 2025. In addition to being a Central Council member, he is also chairman of the Board of Studies, Peer Review Board, members of Students Services Directorate, and Center of Excellence, Hyderabad. And he is also a vital cog in the Strategic Planning and Vision Monitoring Committee of the ICAI, which is called ICAI Vision. In terms of recognition and speaking appearances, if I start telling about CA Dayanivas Sharma ji, it will take us a lot more time. So just keeping it short, I will like to invite CA Dayanivas ji. Welcome, sir.
Thank you very much, Vasu. Thank you very much. And indeed, very short, but giving credentials about any other person makes a whole lot of difference. Thank you so much. And I'll request Somashekar sir to come on screen for a moment. For only one reason, I was Somashekar sir. Good evening.
Good evening.
Dayanivas Sharma. And the best part was I was going through the presentation. I was listening to the presentation, and the way you have taken, evolution, or rather, the entire process of banking fraud and the way that has been gone up and now it is coming, and the kind of focus with which the banking system has been working. And you took certain very interesting case studies. Okay. I can only compliment you for that, examples which you have taken very methodically, line by line, whether it is foreign transaction or it is an Indian transaction, that has come out fantastic. Rather, I can tell you, the people who are participating today are, enjoying, I believe, in total, and giving their positive feedback in overall basis. Though I never had an opportunity to interact with you, but I think you are now on the radar of the Digital Accounting and Assurance Board on a continuous basis. And more importantly, friends, I can tell you one thing: the banking frauds, the way that has been evolving, the kind of control mechanism, the governance which is being reported, and more importantly, the kind of review mechanism which Reserve Bank of India has put in. And furthermore, with IBC coming into active role and decisions being taken out, and a lot of such things are being happening at a national level. So if you see the entire transition which has gone through, when you talk about a reporting of NPA in a banking sector, from where it started and where it has actually moved up, and the peak which has gone up has been huge. And that has gone to a 10 lakh crores of accumulated NPAs, if I'm not wrong, Somashekar sir, or more than that only.
Yes.
Close to 10 lakh crores of NPA which has been reported, which is nothing but, I think, a bank can be created out of it. That's the reason I think that was a NPA bank was, bad bank was being proposed. Yeah, bad bank was being proposed. And considering those all factors, plus the most important part is the IBC proceedings which have actually initiated, the forensic audits which have been happening. There has been a good amount of exposure for our chartered accountants at large. Also, I think bankers have gone into a different zone. They have been thinking multiple things. How do we actually control this entire process, including the basic statement of stock, to the net worth statement, to the personal guarantees which are being given by promoters. So many things have happened. Not only that, but also circular transaction which have impacted holding subsidiary relationship, associate relationship, foreign subsidiary relationship, and the way the enforcement directorate has actually tracked all these transactions, and they have set an example that, now any person doing bad, we will treat them bad. That is the kind of fact which has been demonstrated at a very large level. And I think that something is there which actually cleaned up to a greater extent, because not only the larger company which defaulted in a big way, but the companies which were below the line, either in form of subsidiary or associate or a joint venture, or might be the suppliers who have been there for these larger companies, the way that has got impacted, and the entire credit rating mechanism which has been again shuffled to a greater extent. So many things have happened in last 3 to 4 years. And particularly when we were talking about the impact which is there in quality review board, I'm a member of a quality review board. Also, it is very important to note, what we have taken is, in the quality review board, the listed entities have gone to NFRA. But whereas the non-listed entities which are there, related party transactions which are there, now related party transaction from SEBI point of view has become very critical. Similarly, all these things, when you're talking about the smaller companies where all these entities which were being used for multiple rotation and all, now they are exploding in a large manner, and the kind of news which is coming out is unimaginable. In all, the fact is, Chartered Accountant Services, who is actually a forensic certified auditor, actually will play a very important role. Though I have certain reservations from the point of view of IBA, the way it is approaching, the way they are empaneling, and the way the work is been given. Somashekar sir, Vasu, all the people who are participating, please understand, a quality of service doesn't come with L1, right? That means a person who is taking on a L1 model is also equally responsible if he is going to provide a high quality service. Multiple such softwares which are to be required today with the audit firms to track the entire transaction, movement of funds, where it is going, what is related party transaction, who's actually impacted, direct, indirect. So many things are actually coming up. And in this process of governance cleaning up, I think lies a responsibility for chartered accountants in a very large manner. And your examples which you have given, Somashekar sir, role of a chartered accountant to certify a stock statement or data statement or a net worth statement plays a very critical role. Yes. So please understand one thing: when a bank is giving a loan of 100 crores, 200 crores only on a certificate of a chartered accountant or net worth, okay, or might be the financial statements, what is the role of a chartered accountant? We all have to be very, very critical on that particular part. So my request to you all people, friends, is now let us be more vigilant. We were vigilant. Let us become more vigilant in certifying certain things. Today, tracking of transaction is the easiest thing. Sometime later, I'll come and talk about digital footprint, which is the new concept which has been thought about. It has been worked upon with lot of transaction like blockchain and all those things. The transactions are getting tracked on totality. And finally, the government has geared up to a finest level. I think as a professional, we need to equally match with them, support them, ensure that we play a partner in nation building role in total. So this is only the suggestion which I have from my side. Vasu, I don't want to repeat what has been talked by Somashekar sir. But I thought I'll just give you an overall view how SEBI is looking into it, RBI is looking into it, IBC is looking into it, ICI is looking into it, and many more such things are going to come in a big way. So get ready. The profession is changing. Let us get ready for the new profession and newer opportunities in time to come. Thank you all. Thank you very much.
Thank you so much, sir. If I just can summarize what sir said in one line from a movie called Spider-Man, with great power comes great responsibility. So that's what I feel he's trying to say, that we need to upgrade ourselves, we need to increase our power, but also increase our responsibilities. So now moving on to our next speaker, CA Lokesh Gupta ji is also joined us. CA Lokesh Gupta ji is a rank 1 holder for ICAI, and he has also qualified LLB from Delhi University and cleared DISA examination with rank 1. And he has also qualified as a forensic auditor from exam FAFD. Currently a partner Shyam S. Gupta and Company. He has experience of more than 20 years of bank audit and has conducted concurrent internal statutory audits of banks in both public and private spaces. As a guest speaker, he has been empaneled with ICI and many study circles where he has been taking sessions of FEMA, FCRA, international taxation, and Forex in various platforms. In addition to his professional and guest speaker responsibilities, he has also been a contributor in various publications of ICI, like the Manual of Bank Audit or Statutory Audit for Banks. So now, without taking much more time from the speaker, I will request Mr. Lokesh Gupta to please introduce himself and take the topic further.
Thank you, Vasu. First of all, I have actually a bad throat, so you will have to bear with me for that. Am I audible clearly?
Yes, you are audible.
Yeah, you are audible.
Yeah. So thank you, the Regional Accounting and Insurance Board. First of all, Dayanivas ji, Nanda ji in absentee, my fellow speaker Soma Shekhar ji, whom I respect very much, and my fellow chartered accountants. Now, the duty cast upon me is to speak about the banking frauds. I thought to start off, I should discuss first, there is a master direction of RBI on banking frauds. So we should discuss about, we should be aware about the provisions of how to do a reporting of banking frauds. What are the provisions which RBI has prescribed for banking frauds? We should be aware of it. It also includes provision for how the reporting to police or CBI is to be done. So in the starting, we will start off with understanding the provisions of the RBI master directions on this. And then I'll try and take up a bit of case studies on banking frauds. Basically, we'll be covering the domestic transactions more. Of course, Soma Shekhar ji were great enough to cover the international transactions. So we'll be basically looking at the domestic transactions. So starting off, I'll just share my screen first. Is the PPT visible, Vasu?
Yes, it is.
Okay.
I think our slideshow on the yeah, it's okay.
Okay, so frauds per se have been in existence for a very long time. Even if I say Kautilya in his book Arthashastra wrote about frauds, and basically the basic objective of doing a fraud, basically to earn something out of it, to gain something out of it, remains basically the same. Now, how RBI basically defines a fraud is a deliberate act of omission or commission. So it has to be deliberate. There can be an omission, there can be a commission, and it can result into a wrongful gain to any person for a temporary period or otherwise, with or without any monetary loss to the bank. So the monetary loss to the bank may not be a deciding factor in deciding whether this amount to a fraud or not. Any wrongful gain to a person would make it a fraud, whether even when it is for a temporary period. Okay. If we look at the current scenario, Dayanivas talked about the current scenario, talked about the changes which is happening in the overall area we operate into. Banking also is changing very fast. And if you look at the 2013 Norton report, it says we are one of the top 5 countries in cybercrime incidents like ransomware, identity theft, and phishing attacks. So this is one, again, an area which is of concern and which requires us to actually improve our knowledge and understanding of the area to be able to be relevant to the business community going forward. Now, this analysis, Soma Shekharji talked about, this is analysis in terms of frauds, the sector wise. So how much frauds are happening, public sector banks, private sector banks, foreign banks. And this is based upon the RBI collation of data only. So if you actually look at it, actually my main point which I wanted to make here is that if you actually look at it, you see there is an increasing trend of frauds which is happening in the private sector banks. Of course, the reason might be also that the private sector banks is also cornering a greater share of the market per se from the public sector banks. And so they are also getting a larger share of the frauds also, which is happening there. But if you actually look at it, 2020-21 figures, they are actually having more than 50% of the frauds are happening in the private sector. Though, to my understanding, they are not even doing like 50% of the total coverage. If you look at the total business per se, private sector banks are not doing 50%, but they are actually having now more than 50% share of the total frauds which are happening in the banking sector. So that is an area of concern, especially when we are auditing a private sector bank. Then the area of operations, if we actually look at it, how is this division of the frauds as far as the operation area is concerned? So the top, of course, would be the advances. So 47.5% is the percentage of frauds which are happening in the advances area. The second area, which is the biggest area, is the card, the internet. So it says 34.6%. So if you actually look at it, this is a new area which we are talking about. This is contributing now nearly 35% of the frauds are happening in this area. So these are the two main areas where we need to be focused upon as an auditor to be able to give, to be able to verify, to complete our responsibilities to give value add to the banking area. Okay. Now this is some slides which I have tried to pick. Frauds. This is Indian Fraud Indicator Survey done by Anderson and some slides I have tried to pick from there. So it says nearly 60% frauds are with the involvement of staff. And as an auditor, we all know that where the staff is involved, it becomes increasingly difficult for an auditor to detect a fraud and then to prove a fraud. So as an auditor, it creates actually a challenge for us in completing our responsibilities in case, especially where the bank is looking at us for getting detection of the frauds. Then what are the factors which are contributing to frauds? So it says lack of oversight by service executives or management on deviation from existing process. So the processes are in place. When there is a deviation, nobody has pointed out that deviation is resulting into a fraud happening. So that is one of the largest areas. The maximum frauds are happening due to oversight. Then business pressure to meet targets and difficult business scenario being the other, where people try to undercut and then try to do business because there is a pressure to meet targets, and this results into a fraud because they circumvent the process or they undercut the process to basically achieve the desired results. Then average loss per fraud incident, and if you look at the recovery in the frauds, if you actually see the recovery into frauds are very, very poor, sir. So if you actually see here, nearly in less than in nearly more than 50% frauds, the recovery is not even 50%. So very, very poor recovery which is happening in case of frauds. How frauds are getting detected? So the maximum frauds are getting detected through audit. It can be internal audit, it can be a legal audit, it can be a compliance audit. So underscores the fact that the audit is one of the major contributor to internal control and needs to be strengthened. Of course, we also need to get new skills to be able to operate in this new era of digital environment. Of course, audit being the largest contributor to the detection of frauds. Then anonymous complaints, whistleblower mechanisms being one of the other areas where these kind of frauds are being detected. Then the analytical solutions, fraud detections, software is being done by the bank. Again, uses of digital mechanism for the purpose of detection of frauds are one of the largest contribution to the detection of frauds. Then RBI has given a classification of fraud. This is based upon the Indian Penal Code. So basically, they have divided frauds into misappropriation and criminal breach of trust. fraudulent encashment through forged instrument, manipulation of books of account, or through fictitious accounts and conversion of property, cheating and forgery, unauthorized credit facilities extended for reward or for illegal gratification, fraudulent transaction in foreign exchange transaction, which of course uh, my fellow speaker Suma Shekharji actually covered, negligence and cash shortages if intention to cheat, defraud is suspected or true. So basically this area D basically comprises of three independent portions. Sometimes we are not aware as an auditor and we actually fail to fulfill our obligation as an auditor there. So basically this section D comprises of three independent portions. First portion says that there is a negligence and there is a cash shortage. Even if you feel there is a if the auditor feels there is an intention to cheat or defraud the bank, then it is to be reported as a fraud. The amount of fraud may be rupee 1, it may be rupee 1 lakh rupees, or it may be 1 crore rupees. If there is an intention to cheat or defraud the bank and it results into a cash shortage, it is to be reported as a fraud. Now this we are able to understand. There is no doubt about it. There is no confusion about it. The second portion says there is a cash shortage. The cash shortage is exceeding 10,000 rupees, including in ATMs. It does not talk about intention. It does not talk about that you suspect somebody had the intention to create a fraud. Only the fact that there is a cash shortage, the cash shortage is exceeding 10,000 rupees requires it to be reported as a fraud, sir. This is very important for us to know, because sometimes what happens in branches is that we are auditing a branch. We come across a case where there is a cash shortage which is reporting, and the reported cash shortage is exceeding 10,000 rupees. We are required to verify whether the correct reporting has been done to the Reserve Bank of India as per the fraud reporting guidelines. Because the fact of a cash shortage exceeding 10,000 rupees that itself is sufficient for a report to be done to Reserve Bank of India. Then third point, it says cash shortage exceeding 5,000 rupees if detected by a management auditor, inspecting officer, and not reported on the day of the occurrence by the person handling cash. So you went for an surprise check, you verified the cash, there is a cash shortage of more than 5,000 rupees. It was not reported on the previous day while closing cash by the persons who are handling cash. It is required to be compulsorily reported as a fraud. Nothing else is to be proved, just the fact that it was not reporting the previous day. You have found a cash shortage which is exceeding 5,000 rupees. It is mandatorily required to be reported as a fraud. So these are the three independent portions which are there, which we should be aware of as an auditor. And then the remaining area, which is any other type of frauds not coming under the specific heads. Example like central investigating agencies have initiated criminal proceedings. So they are to be also reported as a fraud. Now the coverage of reporting, they say banks other than foreign banks having overseas branches office should report all frauds perpetrated at such branches offices also to RBI. So like maybe SBI having a foreign branch, a fraud committed at the foreign branch also needs to be reported to RBI. Bank may also report frauds perpetrated in their subsidiaries and affiliates joint ventures in FMR format in hard copy only, but where the subsidiary affiliate JV are not required independently to report frauds to RBI. So in case of affiliates, etc., also a reporting in hard copy may be required to be done to the Reserve Bank of India. Then basically, if I divide the bank frauds can be divided into deposit-related frauds, advance-related frauds, and then service-related frauds. We'll, of course, get into this area in more details once we start getting into the case studies of frauds. Now, how the fraud is to be reported. So there is a software package which RBI has provided to all the banks. It is called as FMR, Fraud Monitoring System, basically. And for reporting a fraud, there is a report called as FMR1, Fraud Monitoring Return 1. So this is an XBRL system, online system. The reporting has to happen through this online system for any fraud, whether the fraud is of rupee 1, it is of 1 lakh rupees, it is of 10 lakh rupees, it is of 1 crore rupees, whatever may be the amount. It has to be reported online through this fraud monitoring system. And There is a central fraud registry which has been created with effect from 2016. It is a web-based and a searchable database which can be used for the purpose of checking on frauds which have already been committed and reported by the banks to the Reserve Bank of India. What is the timelines for reporting of a fraud? So it is within 3 weeks of the detection of the fraud. So from the date the bank has detected that fraud, 3 weeks they have got to report the fraud to the RBI, XBRL system, online system, any amount involved. Okay. Earlier, there was also a requirement of doing a hard copy, which was withdrawn. Now, only there is a monthly certificate which is required to be given every month that all the reports, fraud reporting has been done to the Reserve Bank of India. In case there is a fraud which is exceeding 5 crore rupees, then RBI feels it is a big fraud. They also require you to do a flash report, fraud flash report, FFR we say, basically. So this fraud flash report is to be done within a week of the detection of the fraud, and thereafter within 3 weeks of the frauds you have to do FMR1 reporting. So it is an additional requirement which happens in case you detect a fraud which is of 5 crore. Then whatever updates are happening in that fraud, based upon your investigation, that also has to be kept on updated on this FMR system. Why timely reporting of fraud is a must? So basically RBI feels that, so they say one, it is a moral obligation of the bank to report a fraud to RBI so that they are able to disseminate that information to other banks so that they can take measures that a similar kind of fraud will not happen in their banks. Secondly, they say that under the Banking Regulation Act, Section 47, Clause A, we can penalize the banks, and they have done also. So we have seen cases where the banks have been penalized for either not reporting or delayed reporting of frauds. And third is, it provides that in case of NPA provision, in case there is a fraud, and the fraud, in case of an advance, if there is a fraud, then there is a 100% provision which is required to be made, ignoring the security which is there. So in case we have delayed in reporting of the fraud, then the bank is required to do that provision of 100% within the first week, the first quarter itself of detection of the fraud. Otherwise, they have the option to defer the recognition of the complete loss of that fraud, providing that complete loss over the 4 quarters, starting of the quarter in which the fraud was detected. So basically, it is kind of a disincentive which has been created that they have to provide for the loss in the first quarter itself. Okay. Then attempted frauds, earlier they were required to be reported. Now there is no reporting mechanism which is prescribed for attempted fraud to the bank. So attempted fraud basically means where a fraud was attempted on the bank but could not be completed due to any factors, maybe due to the system stopping the fraud from happening or due to fraudster not able to complete the fraud for any other reason. So attempted frauds are now not required to be reported to Reserve Bank. Reporting of fraud by auditors. This is very important for us to understand. These are 2 paragraphs which are there. It says who specifically reports simultaneously to the Chief Executive Officer of the bank and Central Office of the Department of Banking Supervision, RBI Mumbai, any matters susceptible to be fraud or fraudulent activity or any foul play in any transactions. Any deliberate failure on the part of the auditor render himself liable for action. Now, this is a very important clause for us. Every person here who's an auditor to a bank needs to be aware of it. Rather, there is a RBI circular which prescribes that these 2 clauses which are stated here, it should be part of the every appointment letter issued to an auditor, whether as a statutory auditor or a concurrent auditor or a system auditor or a stock auditor, whatever. And this requires, this mandates that we do a reporting directly. So up till now, we have discussed the reporting requirements from the bank side, what the bank has to do to report a fraud to the RBI. This is talking about our responsibility as an auditor to report a fraud. And this is independent of the reporting which the bank is going to do. And in case we are not fulfilling our responsibility of reporting a fraud, then we can also be proceeding against and a panel action can be initiated against us for not fulfilling our responsibility. So this becomes very important that we verify, and wherever we are required to do so, we report frauds to both the Chief Executive Officer and to the RBI in case a fraud are detected by us. Okay. Then it talks about closure of fraud cases. So what are the steps which are required before a closure of the fraud can be done? Of course, it means basically that the investigation is done, the examination of staff accountability is done, the amount of fraud has been recovered or written off, insurance claim in case it is so applicable has been settled. So this is basically what is required to be done before the frauds can be closed. So a closure report needs to be filed to the Reserve Bank of India. Okay, and then the circular also talks about reporting of frauds to police and CBI and provides specific guidelines as to when a fraud is to be reported to police and when it is to be reported to CBI basically. In case of private sector banks, including foreign banks operating in India, all are to be reported to state police authorities only. Okay, so there is no reporting which is prescribed for CBI. In case of private foreign banks, they say that any fraud of 1 lakh and above committed by outsiders on their own and or with the connivance of the bank salaried officers are to be reported to police. Cases of fraud committed by own staff, employees of 10,000 and above are mandatory required to be reported to police. And in case of frauds of 1 crore and above, then as further reporting is also required to be made to Serious Fraud Investigation Office, Ministry of Corporate Affairs, Government of India, New Delhi. So this is an additional responsibility which has been cast upon the bank to report those fraud to Serious Fraud Investigation Office. So 1 lakh fraud done by outsider, 1 lakh and above, reporting to police. Done by own staff, 10,000 and above. If it is amounting to 1 crore and above, further reporting to Serious Fraud Investigation Office. Then, in case of public sector banks, they say that in case the fraud amount is of 3 crores and above, then in that case, the reporting is to be done to Central Bureau of Investigation, CBI, basically not to the local police. In case of amount between 3 crores and 25 crores, where staff involvement is prima facie not evident, CBI economic offences wing.
Hello. I think network issue आ रहा होगा. I think he will join back shortly. Yeah, he's joined back. Sir, मैं unmute.
Yeah. I think drop हो गया ना बीच में.
हाँ. आपकी सर स्लाइड चल रही थी स्लाइड पे पर
अब आ गई स्लाइड्स आ गई है.
हाँ.
Now it's review. Now it's there.
Okay. So sorry for that drop in the connection. Now, in case of I was talking about reporting to police in case the fraud amount is of less than 3 crore rupees. If the fraud amount is between 1 lakh, more than 1 lakh rupees, then RBI says that the reporting has to be done to the state CID, Economic Offences Wing of the State Police. If it is between 10,000 and 1 lakh, it is to be done to the local police station. And if it is less than 10,000, then the regional head would take a call whether reporting to the police is required or not. and based upon his decision, a reporting would be run, or the bank would refrain from reporting to the local police. So this is the guidelines in relation to reporting of frauds to police. Now, this circular also talks about reporting of basically frauds to reporting of thefts, burglaries, dacoities, and bank robberies. Though these are not practically frauds, these are criminal offenses otherwise. They do not amount to a fraud, but the reporting is prescribed in, there is a format called as FMR4, and it has two reportings which are there. One on immediately on happening. So these are the 5 authorities where a reporting is to be done, and there is a quarterly return. 15 days from the end of the quarter, you have to do a reporting on that XBRL system, the fraud monitoring system only, and nil reporting is even mandatory here. So this is the now, in case of check-related frauds, these are some of the guidelines which the RBI has given. These are again not mandatory guidelines per se, but these are something which are suggested to the banks. And now we have seen most of the banks actually following these guidelines. So basically, it is related to CTS checkbooks, which you have seen all banks actually complying with. Then we are talking about examination of checks under UV lamps beyond a certain threshold. So that is very important. Then checking
I think his connection has again gone. Ayaz, you there? Somshekhar sir,
is there a problem?
हाँ आपका फिर से ड्रॉप हो गया था.
Is it okay now? Okay. Okay. Is it visible now, Vasu?
Yes sir, go ahead please.
Yeah, okay. Now, then it talks about customer calling and confirmation of the peer drawer and contacting base branch in case of non-home checks. So these are some of the guidelines which are not mandatory at present, but of course, most of the banks have already started implementing these guidelines in relating to check-related frauds. Then there is a framework for loan fraud. This is basically in case of exposures of banks of 50 crores and above. If we see actually the change, the LFAR which has come last year, it also talks about red flagged accounts and early warning signals. Even my learned friend here, Soma Shekharji, talked about red flag, basically the early warning signals. So this is also coming from this fraud circular only, basically. Earlier it was a separate circular which was then in 2017 was incorporated within the fraud circular itself. And this is applicable to loan accounts where the exposure is of 50 crores and above at the level of a bank. And what is a red flag account? Basically, they have defined a red flag account is one where a suspicious of fraudulent activities thrown up by the presence of one or more early warning signals. So they have defined two things. One is what is a red flagged account and what is a EWS, early warning signals. So basically, red flagged account, they say, is one of those accounts where you feel there is some fraudulent activity which is going on in the account, and how you have determined that fraudulent activity is the presence of early warning signals in that account. And they have given a list of those early warning signals also. And they have said that this early warning signals which we have prescribed is not an exhaustive list. Banks can add to it. Banks can also delete any early warning signals which they feel is not required, and they can create their own early warning signals and basically keep on checking that any such account where these presence of early warning signals is seen. In case any such early warning signals is seen in any account, then there is a process which has been prescribed for such cases, and the process basically requires reporting to the fraud monitoring group of the bank that early warning signals has been noticed in some account, and then they would verify whether there is early warning signals in that account. Based upon their satisfaction, they would do a red flagging of the account. This red flagging of the account would be done on an online platform which is called as Trillic, CRILC, Trillic. platform we say. It is an interbank platform which RBI has designed. So basically what the bank would do, it would mark that account as a red flagged account in CRILEC. What is the advantage of that is basically the bank is not saying it is a fraud as of now. The bank is only saying that we have a suspicion that the account has some problem, some fraudulent activity has been done into the account. We are not declaring this as a fraud right now. We are under investigation. The benefit basically is the other banks who may be dealing with the customer would be put to notice. They would be more careful while dealing with the customer, and they would take that into account while they are taking any credit decisions with that borrower basically. And then they have given a timelines within which you have to decide whether this account is a fraudulent account. If it is a fraudulent account, it has to be removed from the red flag status and put into a fraud account. If it is not a fraud account, then it has to be removed from the red flag status. So for that, they have given some timelines. So this is one of the things which you have to keep in mind. It is kind of an early warning system which they have designed for the bank for larger loans. There is a specific reporting which comes in form of the LFAR reporting, where we have to report on such cases. So that we need to keep in mind as an auditor. Then there is a requirement of getting a legal audit for title documents, which they have prescribed for all credit exposures of 5 crore and above. There should be a periodic legal audit and re-verification of title deeds with the relevant authorities as part of the regular audit exercise till the loan is fully repaid. So that exercise which is done at the time of credit appraisal, verification of those documents of property, etc., that has to be re-verified, right? For all cases of 5 crores and above till the account is finally closed. So a legal audit is required of those documents. So that they have also prescribed. So these were the guidelines in relation to the RBI audit. Now, some case studies on frauds. I've tried to divide those case studies into either advances and the new area relating to internet banking, etc. And the third is in relation to other operational areas. So basically, just to take you through the case studies. One, in case of advances related to plots, properties, where properties were taken as a collateral or primary securities. One of the major frauds which we saw was same property sold to different individuals and also equitable mortgage to different banks on the basis of forged title deeds to obtain credit. So basically, colored photocopy done of title deeds given to different banks, equitable mortgage done on that, and loans obtained from different banks. And when the loan was not repaid, suddenly the bank realized that the same property has been mortgaged to different banks. So there, the pre-sanction and the post-sanction verification was very important. And this prompted the government to also come out with a charge to be created under SARSAI. So under SARSAI, creation of charge becomes very important. And what I always advise my fellow auditors is that when we talk about creation of charge in the SARSAI, please do when we create a charge in the SARSAI, there is a charge ID which gets generated. Please do not only refer to the charge ID. Please look at the form which has been filed while creating the charge with SARSAI. Why it is so important, sir? Because SARSAI do not have a list of all the properties, and you select one property and say this is the property which I have a mortgage with the bank. So it only looks at when we create a charge whether there is a property with the same identification which is already registered with SARSAI. So in case we do an error, let's take an example. Suppose there is a flat which has been mortgaged to the bank. The flat number is 203. But while creating that charge in the SARSAI, by mistake, there was error. The flat number was put at 2003. So that 2003 may not be any flat in existence, but because that flat number is not matching, the SARSAI would create a different charge. So it becomes increasingly important for us as an auditor that when we are required to verify creation of a charge in SARSAI, we actually verify what is the exact description of property which has been put while creating that charge, whether that matches with the title deeds document which have been submitted to the bank. And as I told you, in case it is not matching, that might create a problem for the bank, and which we need to bring out through our audit. Then In case of under construction property, so we saw a lot of frauds being committed against the bank. One such fraud was, which I noticed was, which happened in Mumbai. So basically what happened there was that there was under construction property. Now in case of under construction property, you cannot create a equitable mortgage because the property itself is not in existence. So what we do a tripartite agreement between the builder, the borrower, and the bank. But what happened in such a case was that this builder sold the same property, same flat to multiple buyers. So say flat number 203 was sold to Mr. A also, Mr. B also, Mr. C also. And he got it financed from different banks. So Mr. A bank got it financed say from SBI, Mr. B got it financed from say ICICI, Mr. C got it financed from HDFC. And later on, the builder did not complete the project and disappeared with the money which he has collected. And suddenly the banks realized that against a single flat, they have multiple finance has been done. So this is one of the areas where the credit control is not there because the equitable mortgage is not happening. Now, what has changed in this is that the guidelines were amended in relation to SARSAI, and now it requires that even for property which has for under construction property, if a loan has been given against the under construction property, the charge also needs to be created under SARSAI for these under construction properties. So please verify when you're doing an audit, then cases of housing loan basically given for under construction properties, whether a charge has been created with the SARSAI for such cases, to basically check on any such cases where the multiple financing may be have been done against the single flat. Then advances, especially in case of gems and jewelry sector. So we have seen a lot of frauds, especially in case of jewelry sector. One of the reason why frauds they are able to perpetrate in case of jewelry sector is the value of diamonds basically. So the value of diamonds is basically cannot be judged by say an auditor which has no understanding of diamonds, how it to be basically calculated, how it is to be defined. So inflated value of diamond to avail higher credit facilities and display higher securities. Then there was a fraud which got committed where export bill remaining unpaid purchased by consortium banks, for which reason given was financial difficulty of foreign buyers. So export bill got purchased, they were not paid by the the purported buyers, and the reason was given was the financial difficulty of the foreign buyers. Details of receivable debtors submitted appear to be manipulated and fabricated. Then pre-shipment credit was availed from one bank and post-shipment from other bank. This is one area which is again a concern area where pre-shipment credit is availed from other bank and the export bill discounting happens from some other bank, which can result into a double finance. Okay. Then secondly, pre-shipment credit availed as standby letter of credit instead of packing credit. So one of the modus operandi they used was that instead of taking a pre-shipment credit in terms of a packing credit loan, they took it as a standby letter of credit, which resulted into fraud later on. Then use of related party transaction. Again, this was a point which even Dayanivas Sharma ji talked about. So related transaction, party transaction to siphon or divert the funds due to absence of due diligence on foreign buyers. So this is some of the issues which have been pointed out in one of the frauds which we actually wanted to bring to your notice. Then advances in relate to manufacturing sector, basically export bill discounted and shipping bill submitted to bank. On verification, the shipping bill submitted were found to be forged. So this forged document was submitted to the bank and against which the credit was availed. The invoices which were submitted had no indicator of any code, grade, mark, etc., which was basically a red mark here as to why the bank should have taken care of such cases. Then fictitious transport operators were used and the documents were forged. Then goods sold to a firm on merchant export basis, which was dealing in electrical appliances, and had the goods were purchased from somebody who was dealing into computer components. So again, something which was not matching. So you're buying it from somebody who's dealing with computer components, selling it to somebody who is dealing into electrical appliances. So again, something which is of a red flag, which should have come to the notice of the bank. And as an auditor, we can point it out such red flags which can result into actually a fraud later on. Then advances in related to housing loan, overvaluation of the property, collision of valuers with borrowers, wrong legal scrutiny reports, or incorrect land records or chain documents, double mortgage, project loan and housing loan. So this is again one area that the builder itself has taken the loan on the properties which are getting constructed. He has sold the properties and the buyer is taking a housing loan. It may result into a double financing. So that is something which needs to be taken care. Then incorrect employment details of fake employers, fraudulent income tax returns, duplicate PAN cards, disbursing loans without taking search reports, fabrication of income certificates, balance sheet, etc., escalation of overall cost of the property to obtain higher loan. So these are some of the concern areas which we have seen in relation to the housing loan. Then in relation to advances relating to jewel loans, then passing of fake gold as genuine by the borrower in connivance with the appraiser. This is one of the common cases which happen in case of jewel loans. And generally, the banks have a system of getting a re-verification done by some other appraiser. So we need to verify as an auditor whether that system is actually working, whether the appraiser is sitting in the branch while verifying these gold or the jewelry which has been submitted to the bank. Then depositing stolen gold in the bank and obtaining loans. So here the KYC of the borrower, it is very important, because in such cases generally the KYC would be fraud. Then double financing of the same gold loan package. This is again one of the areas where there is a concern that against the same gold packet there is a double financing. It can be intentional also. It can be sometimes done by the bank by mistake also. What we have seen recently during one of the audits which we were doing was that in case of jewel loans, there is a typical issue that the jewel loan has to be repaid within a period of 1 year. So there is a bullet repayment of jewel loan packets. Now, what a lot of banks are actually doing is that in case that repayment does not happen, then the bank, that loan would become overdue, and after a certain period, it will become a NPA. So what they are doing is again the same gold packet, they give another loan, and through the proceeds of that second loan, they actually settle the first loan. Right? In one of the cases, what we found was that not only the bank was doing this practice, secondly, in one of the cases, we found that against the same gold packet, there was another loan which was given. But the first loan they forgot to settle. So there was a first loan which was already there, and the second loan was again disbursed to the savings account of that customer, which he has already utilized. So against a single package, there was a double loan which was there in the branch. Then overvaluation to draw excess bank finance. This is again one of the problems that with the connivance of the appraisers, there is an overvaluation which is done and which results into, or then an excess rate which is applied to the jewel loan and to increase the valuation and draw excess bank finance. Then gold return to borrower and the finance company. And this is again, we have seen cases where the gold packet was returned to the customer, but the bank forgot to actually settle the loan amount. Either it was deliberate or it was something which was a negligence on the part of the bank, needs to be investigated. But we have seen such cases where the settlement did not happen, but the gold packet was returned to the customer. Then identity theft. So basically, now we'll talk about these new cases which are coming relating to identity theft and internet banking, etc. So one is in relation to phishing links, basically. So fraudsters create a third-party phishing website which look exactly like the genuine website, like a bank website or e-commerce website or a search engine. And then they circulate these links to these websites through SMS, social media, email, instant messaging apps, etc. When the bank clicks on those, they are taken to this fake website where they use these fake website for the purpose of putting their username, passwords, OTPs, etc., which is captured by the fraudsters, and they actually go to the original website, log in, and do the transactions. So this is a very common thing which is happening in a lot of cases. Then phishing calls. So basically, where customers are called on either telephone or through social media, posing as bankers or company executives, insurance agents, government officials, etc. They gain confidence and then they basically try to draw the confidential information of the customers like name, date of birth, which they can misuse for the purpose of doing the frauds. In some cases, the customers have been basically uh, the customers have been basically pressurized or tricked into giving passwords, OTPs, PIN, card verification values, etc., and which has resulted into frauds in the customer service. Then identity fraud cases like online sales platform. So basically, online sales platforms are created. Many you must have heard cases about people selling goods on these second-hand sites selling second-hand goods, where people make their account, they show their interest into the goods, and when the customer they decide on a price, and when the customer agrees, the person agrees to sell them the goods, they sell them, send them a pin, or they send them a link, and they ask them to click on that link, and which results into a fraud. So these kind of frauds we have also seen. Then fraud apps itself. So we have seen cases where fraudulent apps have been uploaded on these Google or Apple sites, and people have downloaded these apps. And when they download, the apps ask for a lot of approvals, and people have actually given those approvals without looking at whether there is any relevance of that approval with the utility of that app. And that app has taken out important information, confidential information from the customer mobile or desktops or laptops. And these confidential information has been basically used for basically doing the frauds. One of the, I think, important points which has come out of all these identity theft is that in case of laptops and desktops, you use a lot of these antivirus or these theft softwares which come. But in case of mobiles, generally we are not using any kind of softwares for the purpose of securing our these phones, etc., where we actually are now storing a lot of confidential information. Our emails are there, even we are using internet banking through our mobiles. So this is one of the concerns which has emanated from these identity theft cases. Then identity theft fraud cases where ATM card skimming has been done. So a lot of cases of ATM card skimming has come, like fraudsters installing skimming devices in ATM machines and stealing data from the customer's card. Or fraudsters have used some kind of a keyhole camera for the purpose of capturing of the details of the customer. And third cases where the fraudsters have pretended to be a customer, trying to help that person in drawing the money, and in the process basically checking the details of the customer's PIN, etc., which they are later on used for the purpose of defrauding the customer. Then identity theft fraud cases through remote access. So basically, it is through these screen sharing apps like desktop sharing you do. Now, a lot of times what happens is they ask the customers to downloading of that app. The purpose may be defined as something of repair of a computer or something. And in the process, they get access to the computer of the customer, and which they have used for the purpose of taking out the confidential information of the customer from their either the mobile or the laptop or the desktop of the customer. Then SIM swaps frauds are happening, where customer SIMs are duplicated, and the OTP come to the customer account, which they somehow by basically telling them that it is for some other purpose, get hold of that OTP for the purpose of changing that SIM. Also, there is another concern which is relating to eSIM basically. So there are certain cases where people are using eSIMs, like for electronic watches, these digital watches which has come. A lot of watches has the provision of using eSIMs basically. Now eSIMs, the problem is that it can be easily manipulated because there is no physical SIM in the system. So these have been used for the purpose of doing fraudulent transactions, because a lot of times the OTPs, the passwords comes on the mobile phone of the customer, and once the person is able to get hold of that SIM of the customer, is able to do transaction, and before the customer actually realizes that his SIM has been swapped, a lot of transaction may have already taken place in his bank account. Then we have relating to search engines. So again, the same issue of fraudulent search engine obtaining information from the customers, and the search engines actually pointing out. So similar websites created, somehow managing that fraudulent website comes on the top of the search engine result. We are looking out for something. We actually get on the first link itself, we get a fraudulent website. People generally do not actually go into details of it, click on that website, and actually results into a fraud being committed against the bank, against the customer. Then we have usage of social media. So social media is something which has been equally misused for the purpose of committing frauds, like Facebook, Instagram, Twitter, etc. So they basically ask for sometimes they give a friend request, they make person a friend, and then basically copy the account for purpose of creating another account, and then ask for payment from their friends, etc. We have seen cases where uh, job search websites have been created where people click, they're trying to find a job, and they have asked for transfer of money in name of registration fee or training fee, or have asked for bank details for the purpose of verification, and that has resulted into a fraud. Then fake loan website has been created, apps has been created, and then they charge certain money for as registration fee or processing fee. Then fake messages in SMS, social media platforms. Um, we see a lot of times people even sending messages on WhatsApp, etc., sending that free gifts are being given by some big company, or free phones are being given. So these are some of the links which are basically misused. So people click on it. It may result into some kind of software downloaded to their computer or mobile phone, or they've been asked to share certain information which may result into a fraud. So this is some of the various methods being used for creating a fraud in case of social media. Then juice jacking. This is again a very innovative way of doing frauds. What happens is they put up a charging port, and people generally when they find a charging port, they feel that okay, let us charge our mobile. So they put that charging port into that the lead which is there, they put it into their phone. Now this lead can actually not only charge their phone, it can also be used for the purpose of transferring the data from the phone also. So a lot of times these fraudulent charging ports have been created for the purpose of not only like giving an impression that we are giving a facility for charging the phones, but actually resulting into some kind of a data breach which has happened to the phones, and these fraudsters getting hold of the important data of the customers. Then lottery frauds. So customers getting phone calls or emails or SMSs saying that you have won a lottery, and then asking them to either share bank details for the purpose of verification, or asking them to give certain money as taxes or forex charges or shipping charges or processing handling charges to receive that lottery amount. So this has happened. Then money mules. Here, some innocent consumer accounts are being used for the purpose of basically money laundering, basically. So customers are led to believe that they are actually doing some kind of a transaction which would result into they earning certain commission, certain service charges, and wherein the intention is to basically do a money laundering. So they are the funds are transferred from one account of a customer to another account, then to a third account or a fourth account, and then ultimately to a fraudster's account, or they are asked to withdraw money and hand over that cash to somebody. And the persons do it under the impression that they are doing a genuine transaction and they would earn out of it. And ultimately they get stuck up because of the getting involved with those money launderings, which has happened through their account, basically. Then this was in relation to identity thefts. There are certain frauds otherwise in other operational areas which I wanted to discuss. This is one of the frauds which happen in Mumbai. The amount of fraud was exceeding of 1,000 crores. Here, what happened? There was a firm which approached multiple banks. They said that they are basically into long-term construction contracts with some foreign clients, and they would get some mobilization advance from those foreign clients. And for the purpose of getting that mobilization advance, they are required to issue BGs to these foreign beneficiaries. Now, beneficiaries were issued by getting a giving some small amount as collateral securities, and these BGs were sent to these foreign beneficiaries, which were actually nothing but dummy parties, basically created for the purpose of the fraud. These dummy parties there in foreign actually offered these BGs as security to foreign banks for the purpose of for getting loans there. And these money which they got from these foreign banks, they send those money as mobilization advance to this entity in India. Now, this entity in India offered this mobilization part of the mobilization advance as again security money for the purpose of further issue of BGs. And they again got those BG issued, and the same process again happened. And they created a substantial sum of money, and then they disappeared. So this was one of the frauds which was committed against multiple banks. So multiple banks got defrauded under this, and the amount of the fraud was more than 1,000 crore rupees. So basically, the issue here was that the money which was got, there was no end use verification which was done by the banks. Basically, because they were not financing per se, they were thinking that they are doing basically a non-fund financing, basically non-fund based limits they have granted. So they were not really too much worried about the funds which have come in. And nobody actually verified the project where that money was to be used, whether there is any movement there, whether any material has been received there, when any construction has been started there. So nobody actually verified that, which resulted into this fraud happening against the banks. Vasu, if there is any question, we can take it in between also.
Let me just check, sir. There is one question from Ramesh from Hyderabad.
Right.
Understand that prior registration of charges with CERSAI are not getting cleared ASAP, unlike charges with ROC. Is it correct? Please explain the impact of this to the subsequent lenders on account of non-clearance of prior charges of CERSAI.
So I think you have raised a very important point, that timely creation of charge is very important. And if we don't create a charge timely, that would result into it may result into multiple financing, because the second bank which has been approached, when he goes for registration of a CERSAI charge, he would not be able to verify whether the financing has already been done against that property by some other bank, because the charge has not been created timely. So, for timely creation of charge is very important. Rather, verification of CERSAI at the pre-disbursement stage itself is very important. So one of the conditions which should be there in case of banks is that before the disbursement actually happens, there should be a creation of charge of CERSAI, and then only the disbursement should happen. So in case the CERSAI creation is happening after the disbursement itself, then I think this is improper and should be reported through the report itself. Okay, so this is very important, sir. Okay. I think I have answered the query, so we'll move on. In case Vasu, we have any other queries in between, you can actually take it up, because
yeah, sure. I think you can carry on. The questions were related to Somashekar sir's session. So okay. If we get time at the end, I'll ask him to answer those.
So what I'll try is we have around 20 minutes which are left, so I'll try to wrap up in another 10 minutes, so that at the last of 10 minutes we can actually take up all those questions, because I think answering of question is equally important. Otherwise, the purpose of the session itself would get defeated.
Yeah, sure.
Right. So a few case studies, another 10 minutes which we can cover. Then unauthorized debit, inoperative account. So inoperative account becomes very critical. One of the area of which is very risk prone as to frauds. So inoperative account debited and fund transferred to own account. This is basically a fraud done by the branch staff itself. Then sundry creditor account of branch debited and fund transferred to own account. So office accounts. Then OD limit enhanced from rupees 50,000 to rupees 5 lakhs. Password sharing was done at branch by branch officials. Monitoring of staff account was not done at branch. Now, if you actually look at this case, this is one of those cases where everything went wrong, right? Now, password sharing. Now, this is one area which is strictly a no-no as far as banking goes. So, banking actually works with the concept of maker and checker. And when there is a password sharing, this maker checker actually fails. So when we see practically a password sharing happen at branch, we may not able to document it. We may not able to prove it. But we actually, when we are sitting in the branch, we are able to see in case there is any password sharing which happens. Please be very careful, because in case the branches in which you are auditing is there is a password sharing which is happening, please be very careful. Why? Because this might result into a fraud, because the maker checker principle has been compromised. So this is very important, sir. And then inoperative account, of course. So we need to verify wherever there has been a change from an inoperative status to operative status. That would generally be captured by the end of day reports which the bank would have generated, the exception report, and also look at the first transaction in the account when the after the account has become operative. Why it is so important? Because the in case it is a insider fraud done by branch staff, the signature access he might have. So he might have created a request from the customer, but the first transaction in the account would actually tell you what kind of a transaction it is, whether there is a cash withdrawal, whether there is a transfer to some account that you need to verify. Suppose there is a transfer to some staff account, then you would be put to guard as to whether it is a genuine transaction, whether even the customer letter given is genuine or not. So that becomes very important. Then fraud in car loan account. Now, in case of car loans, practically there are two types of frauds which we have seen. One is the money is paid, the car is not taken. So generally, the process in banks is that the money would be paid directly to the account of the car dealer. But sometimes what happens is that they make the payment to the customer. He takes the DD and he says that I get the car delivered, which is not proper. So we have seen cases where the money was taken as a loan, but the money never reached the dealer, or the money got refunded from the dealer, and the car was never taken. Secondly, what we have seen, another frauds which are happening in case of car loan is that first they get a estimate from the car dealer. Now the estimate is taken from the car dealer of the highest model, and when they actually buy the car, they take a lower model, which results into the erosion of the security of the branch, because the margin itself is taken is not paid by the customer. So these kind of frauds are actually happening. So we need to be very careful, and we can use a system called as Vahan. So there is a portal of Vahan. You can actually send a message and you can know the details of the car, who is the owner, whether there is a hypothecation or not. That you can see by actually looking at Vahan. And this is one of the best ways of verifying the car loan situations. Then fraud through requisition of checkbooks. So plain paper was used for requisition of checkbook in place of proper counterfoil. Customer and email and mobile was modified beforehand. Why email and mobile was modified? Because most of the cases now bank would send a kind of a trigger message in case a checkbook request is received or a checkbook is issued. Then the signature of customer forged and checkbook obtained. Checkbook used for fund withdrawal, and customer came to know only after updation of the passbook or after receiving the message for the withdrawal of funds. Then fraud through returned security items. So this is one of the frauds which we see, which we practically saw in one of the comptroller audit branches which we were auditing. So there was the branch was very large. So they have appointed a new person which has come in as a person to look after the inward outward tax of the branch. So it had a huge forex area also. So a lot of mails, important document used to come also. Now, what was happening there was the customers who asked for these debit cards, ATM cards, password, etc. They were to be directly delivered to the customer's address. In case it was not so delivered, they used to come back to the customer to the branch. Now, it used to come to that same person who was receiving all that all that couriers. Now that person understood that once the card is received, there is a likelihood that the password would also be received in 1 or 2 days. So what that person started to do was he used to keep the cards with him, and when the password used to come, he used to go out and do shopping against that cards. And this fraud actually came into picture when a lot of customers actually complained of misuse of their account. That there has been a shopping which has been done on their account and which they have not done. And they have said that we have requested for a debit card which has not been received. And then suddenly after investigation, the bank realized that this is that security items which has been returned to the branch, which has been misused by the branch staff, basically for the purpose of the fraud. Then fraud through misuse of office account. Now, office account is one of those accounts which are very fraud prone area again. Why this is a fraud prone area? Because these are not customer accounts. So any transaction you do in an office account, nobody is going to come and complain. And there are large number of transactions which keeps on happening in these office accounts. So in any case, any transaction would not arise any suspicion per se. So as an auditor, we need to be very careful about these transactions which are happening in the office accounts. What is the nature of those transactions? Any outstanding entries which are outstanding for long, that needs to be monitored. Fraud and withdrawal after death of account holder. Account holder died on 1st September 2011, of which intimation was given to the bank on 11th May 2012. Branch staff noticed cash withdrawal in account after date of death. On verification, it was noted that the withdrawals were made through withdrawal forms using thumb impressions. On investigation, same was done by some relatives of deceased. As the case related to forgery, same was reported as fraud. So in case of a person who's illiterate, he uses a thumb impression. Generally, the bank insists on some kind of identity document, and the customer is required to be present for the purpose of cash withdrawal, which was of course not done in this case. And as it was a case of impersonation, it was reported as a fraud. Then fraud by fraudulent account opening. So forged KYC documents were used of some company ABC Limited, and the account was opened. 15 high value DDs were deposited into the account. After cleaning, the funds were transferred by RTGS to some other bank. Directors of ABC Limited came with letter of thanks sent by the bank stating that the accounts were never opened by them. On investigation, accounts where funds transferred to other bank were also found to be with forged KYC. So misuse of KYC and resulting to a fraudulent account opened, and basically funds which were meant for this company was somehow taken out by depositing into this account and then getting it transferred to some other account. So again, a risky area as far as KYC is concerned. Then fraud by fraudulent cash withdrawal. Branch manager would not issue computerized passbook. Cash deposited were entered in system and passbook manually. Next day, similar amount would be withdrawn from customer account by forging signature. This entry would not be made in the customer passbook. Whenever customer came for cash withdrawal, the funds would be managed from some other account. So two set of books have been created by this branch manager. One is what is happening in the system, and another is what is happening in the passbook. So now typically this person would never take a leave, sir. Would never allow somebody else to sit on his seat. So staff rotation, and there is a RBI circular now on mandatory leave to bank employees. So it is mandatory for the bank employees to take a leave, and during the course of the leave, they are not allowed in any ways to have any access to the systems. So this is one of the reasons why it is so important. Then fraud by kite flying operations, fraud by loan in name of non-existent staff, again a KYC issue here. Then fraud by duplicate FDR. So there was a fraud which was committed. Again, the fraud amount was 252 crore rupees. So there were some FDs of some development authorities which was lying with the bank. Duplicate FDs were issued against these FDs without the concurrence of the development authorities. And the loans were created, demand loans were created against these FDs by forging the signature. And the money was basically misused. So this is one of those cases. Then the last slide before we open it for discussion on any issues we have. fraud by duplicate FDR again. So here two FDRs were created in favor of executive engineer only. So in case of these road contractors and all, construction contracts and all, generally they have to give a security and they get a third party FD issued for these purposes. So these two FDRs were issued in favor of executive engineer only. After a few days, the customer came saying that he has lost those original FDs before he could submit it to the executive engineer and got hold of those duplicate FDRs. He got it duplicate FDRs issued by the bank. Ultimately, he has already deposited those original FDRs to executive engineers and he has got a duplicate FDR now. Now, after a few days, he came back and said that the contracts was not given to him and asking for the cancellation of those FDs. On the basis of those duplicate issued FDRs, the bank actually complied with it. And later on the basis of the original FDRs, the executive engineer made a claim on the bank. And the bank suddenly realized that they have been defrauded, basically. So these are some of the frauds which I wanted to discuss with you. Now, I think 10 minutes are left. So I'll open it up for any question answers which we have, sir.
So, sir, there are two queries which I see mainly. First is from Kochi V. Subramania ISD asking, sir, is identity theft, phishing fraud, social media frauds, whereby customers lose money from the bank accounts and update to the bank to be? Yeah, he's basically asking for two questions. First is identity theft, phishing fraud, social media frauds, whereby customers lose money from their bank account, and even they complain to the bank that they have lost money due to these frauds. Are these to be treated as frauds on the bank? And what is the auditor's responsibility in case of such fraud?
So, sir, I think when we talked about the definition of fraud in the initial paragraph, I talked about the fact that if there is a wrongful gain somebody has got with or without monetary loss to the bank, it would amount to a fraud. So if there is a fraud which has been committed against the borrower and the bank has not been defrauded per se, so bank is not responsible for it, bank is not defrauded, only the customer has been defrauded, this would also amount to a fraud and would be required to be reported as a fraud by the bank. I think this is his query. If I get it correctly.
Also, the second query, in case of online loan scams, it appears companies registered under the Companies Act are indulging in such activities. It is alleged that these companies were incorporated or audited by CAs who are now facing action by the Government of India or the police. What are the precautions to be taken by the auditors while auditing accounts of companies indulging in online loan business?
So, sir, I think basically what we need to verify in such cases is, as an auditor, we need to verify whether all the transactions of that company are on board. Now, what is most important here is, and again, I'll come back to the point which Mr. Dayanivas Sharma raised here, is that we need to equip ourselves to be able to understand. So, one option is to basically look at transactions only from the point of view what company has reported in the books of account. Now, the point of time where we need to understand that there is a risk involved in case the company is doing any fraudulent transaction, they are not likely to book it into their books of account itself. So we should be able to verify that website, the transactions which are happening on that website, what kind of audit link it is generating, what audit risk it is creating for us. And then based upon our verification through that audit tools, we should be able to report accordingly. So that is the time where we need to equip ourselves with the audit tools, the digital audit tools for the purpose of those verifications.
Okay, sir. This is a general query which was asked in Soma Shekhar sir's session, but I feel it's a general query, so I'll just ask it right now. Every big fraud brings in changes in laws and regulation. Can you quickly cover the changes or amendments made due to fraud discussed and your perspective to mitigate the same, emphasizing the fact that where did the existing control process go wrong? So it's I think the answer is a bit long for this. So if you can just summarize a bit of the answers.
Ultimately, what I'll say, Vasu, is that of course every fraud And if you actually look at the fraud exercise which we have seen, the reporting which goes to the Reserve Bank of India, they are more actually concerned with the modus operandi of the fraud. And why they want to understand the modus operandi is to basically do corrective action, so that any future cases of such frauds can be taken care of, or some internal control procedures can be devised so that such frauds cannot be done going forward. Let's take an example to understand it, because we cannot do it for every case, but let's take an example to it, though I will be basically venturing into the area of Soma Shekhar sir's area. Now, in case of, we remember the PNB scam which happened, the Nirav Modi scam. That scam happened in the area of buyer's credit. And what was the issue which was pointed out through that fraud was that somebody sitting in some branch was able to create liability for the bank by sending messages through SWIFT. So that buyer's credit required the bank to issue a letter of comfort or letter of undertaking, and that was being sent through SWIFT. Now, what they found was that you can actually send message through SWIFT, which creates a liability for the bank without actually making any entry into the accounting software of the bank. This was the major issue which was pointed out through that fraud investigation. And what it resulted into was, though there was already a circular of the Reserve Bank of India asking all banks to ensure that no person should be able to go directly to the SWIFT system, send a message through SWIFT system without going through the accounting software itself. So they then again enforce that after the PNB scam, they asked all the banks to give a compliance report that they have modified their system, that no officer of the bank can enter into the SWIFT system alone without going through the accounting software. So this was basically trying to take care of that weakness in the internal control which was pointed out through that fraud. So I'm sure every time there is a fraud, the modus operandi is noticed. They try to find out what kind of a audit procedure, internal control procedure which can be prescribed for the purpose of ensuring that such kind of frauds do not occur in future. But of course, as I read somewhere that any person who feels his system is foolproof does not take into account the ingenuity of the fraudster. So it is always a cat and a mouse game. You do something to improve your system, the fraudster comes out with something else. So it would a continuous exercise of trying to improve your system, and the fraudster trying to somehow circumvent the system or somehow finding weakness in the system to be able to do a fraud. So that would always continue, sir.
Okay, sir. Thank you. There is two last queries for Soma, sir. Soma, sir, are you there?
Yeah, I'm there.
Sir, one query is from Sharad Agrawal of Gwalior. He's saying a genuine defaulter and a willful defaulter, are they clearly defined in Banking Regulations Act 1949 for the purpose of classification? And if so, what is the criteria?
I'm not clear on the question. What is the question about?
Basically, what I understand from the query is he's asking when there is a defaulter who is genuine, who is not able to pay because he doesn't have the funds. And there is a defaulter who is a willful defaulter who's just decided not to pay only. Okay. Is there any distinction between the two? And are there any guidelines or criteria in the Banking Regulation Act for that?
No. See, when you talk about a genuine defaulter and a willful defaulter, by experience, see, as a banker, I can tell you, rather than, I don't think there are any regulatory guidelines to the banks to define who is a genuine and who is willful.
Sir, I'm stopping you in between. There is a master circular on willful defaulters, which is there, which actually defines the complete process of how a person can be declared as a willful defaulter.
No,
without following that process, actually, bank cannot go for declaration of a person as a willful defaulter.
No, I'm not coming to the theoretical part of the definition of the guidelines. What I'm trying to emphasize is, as a banker, when I'm speaking to a client as to why he has not paid the amount on time, the responses the customer gives, the background with which he asserts his responses, by experience, I'm able to make out whether the reasons he is providing is beyond his control or willfully within his control. So as a banker, I'd be able to gauge about the reasons he has provided, and I can consider him as whether he requires any extension in the repayment period, or whether I need to stick to my stand and ensure further processes. So this is more of a practical aspect rather than going into a theoretical definition of a genuine defaulter or a willful defaulter. So I look into practice. See, when a customer walks into the branch and says that I'm unable to repay the money, I will ask him, what is it forcing you not to repay the money? So here, most of the frauds can be averted. Most of the manipulations can be averted by discussing with the client in detail. The more you speak to the customer, the more you'll be able to assess the customer's credibility. That is my practical experience. I will be able to prove this also. So this is what a banker has to understand. As a banker, speak at length to the customer to find out what is the interest involved in the transaction. And if the reasons put forth by him are satisfactory to you, you can as well provide him an extension also. Or if you feel that the reasons given by him are absurd or not to your satisfaction, you can immediately recall the amount. So even before going to the books of RBI, I can look into that. That is where we look into our experience and complete the discussions.
Sir, one last thing. Many people are asking for a mobile number and email ID. So if you can just repeat the same for their reference.
Yeah. My email ID is somforex@hotmail.com. somforex@hotmail.com. And my mobile number is 8454946661. 8454946661.
So I think
no, I look at every query, I look at in the practical scenario. See, it's not always required that you have to always refer to RBI guidelines or you have to go to RBI for concurrence. Most of the guidelines are logically driven. Even if you talk about a FEMA regulation or even in the erstwhile scenario, a FERA regulation, everything is through logic only. As a banker, as an experienced banker or as an experienced corporate, what is it that you are looking into? If your intentions are genuine, the regulations also are logically laid out. That is what we look into when we discuss with the clients.
Okay, sir. Thank you so much. I think we are done with the queries also for today. So for any person who still feels that they have some questions, they can contact the esteemed speakers, Mr. Somashekar sir and Mr. Lokesh Gupta ji directly. I think Lokesh Gupta ji, आप भी एक बार अपना number email ID बता दीजिए.
My email ID is ca.lokeshgupta@gmail.com.
Okay.
And my mobile number is 98104-34904.
Okay, Ayaz, can I go ahead with the vote of thanks now?
Yeah.
So thank you so much to the esteemed speakers for a wonderful session of learning of 3 hours. As we all know, banking frauds are on the rise or were on the rise from during the last decade. And we as chartered accountants play a very important role in detecting and preventing the same. And for doing that, what we need to do is keep updating our knowledge and our skill sets. And this session, I think, went a long way in helping us to do that. So thank you so much, sir. And in the end, I would just like to say happy Janmashtami to all the participants. So I think it's time for you all to go to have some Makhan Mishri. And it was very ironic and funny that I was able to host you. And my name is Vasu. Thank you.
Thank you. Thank you very much.